everyone, a very good morning to everyone. And so today is Saturday, so let's start with the thorough revision of module A. Today we are going to discuss the module A plus module C. We see all the theory concept in this. Okay, then tomorrow we are going to complete our module B and D. Okay, so this is the strategy where we are going to see all the theory part. Today we are going to learn about A and C, and tomorrow B and D. Okay, all the theoretical part. For numerical part, there is module wise marathon uploaded. Okay, for E, B, C and D. And for MCQ, in the week of examination, we started from module A, B, C and D, 4 classes, 4 modules, more than 100 questions per module. Plus, these questions are fresh questions, like not copied from anywhere, just and not a Macmillan question, so very fresh questions. So basically, this is the strategy. So let's start with module A and try to see the thing, and I will provide you the PDF also, so you can get the things easily, or you can do comment if you don't need any type of help. Okay, so starting with module A, the longest module and the most important module, and in this we are learning about the foreign exchange transaction. Now forex exchange transaction means FX transaction, forex exchange transaction, or foreign exchange transaction. Means this is type of a transaction or the agreement to exchange one currency to another, but there is a fixed rate available, either immediately or on a future date. This rate means exchange take place is called the exchange rate. Like 1 US dollar, we know that is equals to rupees 82.42 paise, and 1 euro is equals to this amount. So exchange rates, we can't say they are fixed amounts because they fluctuates in every 4 seconds. So that is the basically we can say that is an agreement just to exchange one currency for another. If I want to exchange Germany currency with India currency, so I have to see that what is the rate there. Like in USA, if I want to exchange the currency, so I will see that 1 US dollar is equals to how much Indian rupees. So for that type of rate, whatever the rate will be there, so I have to exchange according to that rate, and that rate is fluctuated. That does not mean if the rate is today 82.42 paise, the rate will be same at the evening, in the evening. So that is the foreign exchange transaction where peoples are doing the agreement that I will exchange this currency at a fixed rate, or either immediately because there are so many deals available, like ready deal is there, right? Or the spot deal is there. Spot deal is one of the famous deal because transactions are basically settled in after 2 days. Then there is a Tom deal tomorrow, like settlements will happen tomorrow, and also one more, that is future deal, forward deal basically. So what is forward deal? Forward deal is basically, we can say, the agreement done on due today this date, but settlement happens on the future date. That is basically the forward deal. So at the rate which the exchange take place is called the exchange rate. Now what are the forex market? Obviously where the trading of the securities happen. Like trading of securities means buying as well as selling, right? This is one of the, this thing happens at a global level. Like everyone can enjoy thus buying and selling of currencies. It even does not exist in any physical location. No physical location. Everyone is connected via via their mobile phones, via their tablets, computer, and internet. It operated 24 hours a day, but Saturday and Sunday is permanently off in this according to the rules. Currently, Saturday Sunday is not working for the forex market, but still it is 24 hours into 5 days available. So what is the global coverage? Obviously from Tokyo to Sydney, Sydney to London, London to New York. The market moves with the time zones, and it ensures non-stop currency trading. It ensures non-stop currency trading. Like everyone is doing the trading of currency in the forex market, and everyone is just want to earn a profit in that market. So we can say everyone is doing the trading here. Okay, okay, just a minute. Now, who are the participants who can do, like who are participates means who are involved in this market? Because of these participants this market is going on. These are the central banks, these are the commercial banks, these are the investment funds and banks and funds. Forex brokers are there who are basically act as intermediaries. They are like those people who are uh, there in the marriage, who takes the guarantee of the marriage, right? Who takes the guarantee of the marriage, who are there for the meeting of bride and groom. So that people are the forex buyers, where the middleman between buyer and seller and take the guarantee for everything is happen for the great purpose. There are some corporations which transfers the money across the border for the trade or investment. There are some individuals that uses the forex to travel for personal needs or the investments. So what are the key features of this forex market? It opened 24 into 5 days. There is no physical location, no particular office. Very highly liquid. Assets can be sell here easily. And sorry, assets, not assets we can't use. We have to use securities or the currencies. There are so many fast moving rates, like major currency rates can change every few seconds. Question is from there, in how many seconds the exchange rate fluctuates. So every 4 seconds, in every 4 seconds exchange rate fluctuates. It is influenced by so many global events, like there are some government policies, interest rates, political events are there. And high volume means there is global trading volume which reached US dollar 6.6 trillion in 2020. And there are so many types of trades also, that is spot transaction, swaps, and the derivatives. And these are all the important thing which are important in any forex market. Okay. And if we see the daily turnover, which is from US 5 billion to US dollar 34 billion, that is the daily turnover. And this turnover I am talking about 2019 to 2020. This turnover is now increased. 5 billion is in the 2004, but you can see the craze of these market that increased to 34 billion in 2019 to 2020. And These exchange traded derivatives averaged this US dollar 12.2 billion daily in 1920. So you can see now people are using technologies. Now people are having the advanced approach. They know the things that how to tackle with the technology and how to use this technology to save the time, and to be smart they use these things. So obviously everyone want to earn money with their own, by the help of profits, by the help of these securities, by the help of so many things. They want to do business internationally also. So there are so many craze increased in the people, so they can do everything. Now what are the summary of the characteristics? We can say that Monday to Friday 24 into 5 it is opened. There is no central marketplace. Everything happen over the counter. It includes the global participants from multiple time zones. High liquidity is there, and so many fast prices are changed very fast. It is affected by political and economic factors. There are so many political factors like government restrictions, or the some type of war type of problem, and like some type of political instability. Economic factors like downturn in economy, recession in economy, so many things are there. So this is used for the trade, investment, speculation, and for hedging. What is hedging? Protection against any type of risk. So this thing is used for trade, is used for investment, is used for speculation, and for hedging. So that is all about the foreign exchange rates, and that is the only thing which we can say about the foreign exchange market, not rates. The chapter is very big, but we can say this is all about the foreign exchange market. Just a minute. So now if I want to tell about any other thing from the for the foreign exchange market, so I can say there are so many types of forward foreign exchange market, like we will discuss about it also. Apart from this, I told you about the major participants which are important thing, characteristics is there, factor which are determining now the exchange rates. So many factors are there. First is fundamental factors. That is basically affecting the long term exchange rates. Just a What do you mean by fundamental factors? There are three factors: fundamental, technical, and the speculation. So let's start with the fundamental factors. See, there are so many quotations in the forex market that depends on the delivery type of the foreign currencies. And we know that there are main factors which influence this movement of exchange rate, which we can summarize, or which we can say that fundamental regions are there. Up now, in this fundamental region, what we can include? We can include all the causes, all the events which are basically affecting the economy, and the policies which is related to the monetary policy of the central government. And here, this cause normally affect the long term exchange rates, while in short run many of these are found ineffective. So basically, in a long run, we can say that, like, some balance of payment is there, is the one thing, balance of payment, which is generally a surplus which lead to stronger home currency, while deficit weakens the same. Means here, if a country export more than its import, if the exports are more than its import, so obviously there is a balance of payment surplus, because obviously export is more than import. Sending the goods is more than the import, so currency obviously becoming the stronger in that case. But if import more than its export, in that case the currency weakens. Then there is a economic growth, that is a fast growing economy increases production and export, we know that, which makes the currency better, which makes the currency stronger. Then there is a fiscal policy, like if the government reduces taxes on increasing the spending, it can boost the economy, which affects the currency value. So fiscal policy is having their own role, right? And in the fundamental factors, we can say that fiscal policy, like example of fiscal policy, some lower taxes that can lead to higher economic growth. And some political issues are there, like instability in the political system, which leads to the uh, economic stability. And there are some interest rates problem also. So we can say balance of payment is a problem, economic growth rate is a problem, fiscal policy is the problem, monetary policy is the problem, interest rates are the problem, and the political issues are the problem. So uh, these are some fundamental factors. Now there is technical factors. What do you mean by this technical factors? That is causes sudden or some type of sharp changes. Sharp changes, that changes is basically when government controls are there, lead to an unrealistic type of currency, unrealistic way of currency, and also which results a changeable movement, a hike movement in the exchange rate, or some type of violent movement. So we can say that in the technical factors, there are so many factors, that is government control, capital flows. So in this capital flows, we can say that big inflows of money from the foreign investor, that can cause currencies to rise or to fall, which depends on where the money moves. Example, we can take the 1997 Asian financial crisis, where the countries Thailand, Indonesia, South Korea, they showed that how much movement are affecting this exchange rates. Obviously every movement affects the exchange rate, because internationally, if we are doing the trading of the security, so everything matters. As you can see in the last tensions with the Pakistan, that thing also affect the market. Why? Because everything is related. So we can say that things are affecting the market. So even the crisis is there, even the any movement is there which is related to political instability, that thing causes the problem, right? Now there is a speculation, that is short term, fast moving. Speculators are the people or the firms who try to profit from currency changes. Speculators mean the like forces that a great effect on exchange rates, and this act can lead to movement in the market. Obviously movement is there in the market just because of these speculators, those people who try to profit. Like, obviously if there is a currency changes, so they find that is there possibility of the profit, so they do this thing. So this is the basically third factor, that is called the speculation. Okay. Moving to the next one, just a minute. Just give me 2 minutes. Okay. So now let's move to the next one. So we know that what are the type of factors: fundamental factors, long term value of currency; technical, sudden and sharp movements are there; speculation means short term changes; and the liquidity. So now let's talk about the exchange rate mechanism. Now, how to exchange the currencies? Exchange rate mechanism means, here are, we can say, there is too much, like the size of market is too much wide, and so many things are going on in the market which operating in already different types of zones, and most of the deals are happened on the spot basis, because one of the famous deal in the forex market, that is spot deal, means delivery will happen on the next 2 days, after 2 days. So we can say that this rate is called the spot rate. And the here the thing means, there is exchange rate mechanism, that how currencies are bought, how currencies are sold, and how the settlement is happened, or the delivery of money is done in the forex transaction. In most of the cases, delivery of the currency does not happen immediately. It's settled. What are the type of deal? As I told you, let's see what are the types of deals. There is a ready or cash deal. Ready or cash deal means where same day as the deal, means everything happens on the same day, payment, settlement, everything happen on the same day. Like deal happen on 1st of November, that means it will be settled on 7th 1st of November. Like A pays the INR and receives the USD on the US dollar on the same day. Then tomorrow that is Tom, which is happening on the next working day. It deals on 1st of November and settles on 2nd of November. If 2nd of November is not a working day, obviously this thing will shift to the next day, next working day. Then there is spot, means T plus 2, second working day, which means deals on 1st of November, so it will settle on 3rd of November. One of the most common type of deal in the forex market. Then there is a forward market, that means another day, like if like deal is happening on the 1st of November, so maybe the transaction will take settlement on 30th of November. That is the forward read deal, and whenever the delivery needed, that thing happened. This is according to the agreement. So obviously Saturday, Sunday is, we are not counting any national holiday, we are not counting. So some things are remember. There is a spot rate, that means 2 working days are needed here, and this rate is also called base rate. Then forward rate means that is the rate which we are agreed for any future settlement date. This rate may be higher or lower than the spot rate. So that is basically future settlement date, we can say, is a forward rate. So what are the example of spot deal? Bank A, if paying or buy this US dollar 1155,000 from the bank B on 1st of November at this euro rate. So bank A pays this euro, and the settlement date is 3rd of November, because this transactions happen on 1st of November. So T plus 2 days, that means 3rd of November, second working day after the deal. So why these spot deals are common? Because interbank transactions are done on the spot basis. The spot market has very high volume, high liquidity, and so many fast moving rates. So that's why we can say this spot rate is the highest craziness between the people of the international banking. They are doing this just for their uh, comfortability, because they feel that this is one of the comfortable level. Clear? Comfort place is called the exchange rate. Okay. Now you can see about the quick recap is there, where all these things are discussed. So that thing is important for the question basis. So many case studies are from there. Even the chapter is some numericals are from there, this concept. So I hope now it is clear that what is a spot deal, what is ready to cash deal, what is the term deal. In very easy way I try to tell you this thing. So let's start with the next thing. Here is the quick recap is given, that is telling about the settlement date, that is telling about the spot rate, forward rate, and spot rate is never equals to the forward rate, which is both are usually differ. Okay. Now forward rates, that is spot rate plus premium or minus discount. Spot forward rate formula is these, means forward rate are based on the current spot rate and adjusted whether the currency become more expensive or cheaper in the future. Like a currency if is at the premium, so forward rate is always higher than the spot rate, right? If the currency is at a discount, suppose what, how can we decide the premium and discount case? See, how can we decide this thing? We know that the suppose the spot rate is today is that much amount which is written in front of you, so that does not mean after the 30 days it will be the same. So suppose, so that does not mean after the 30 days it will be the same. So I am saying that if the British pound US dollar is 1.3670, after 1 month it this rate become 1.3690, so there is an increase of 20 points. That is called the premium. But what happen if the rate is today 1.3670 and this rate will become 1.3640, so you can see the difference, you can see the decreaseness is there. That is the case of discount, meaning US dollar is at the premium but British pound is at a discount. So that thing is basically considering the premium or discount. Is that clear, that what is forward rate and premium? So this is the thing behind, this is the concept behind the forward and the discount rate. Clear? So keep the formula in your mind, that what is the formula basically. Now, why do these premium or discount happens? Because there are interest rate differences between the two countries. When there is differences between the two countries, that interest rate difference that causes a premium or discount. Demand and supply expectations for the currencies. Some other factors like capital flows, import and export, political stability, there is a speculation, there is economic or trade policies. So in the open market, the free movement of capital is there, in which the interest rate difference is one of the most common and most important factor. Clear? So now, direct versus indirect quote. What do you mean by direct and indirect quote? See, this direct and indirect quote is there, which helps us in understanding the concept betterly. Now let's see what is the meaning of this. Okay. If we see about this direct or indirect quote, we know that the when the home currency is variable, that is called the direct quote. Means if the US dollar is, we know that this amount is for US dollar. So how many INR is there for 1 US dollar? And in indirect quote, basically home currency is fixed. Means INR 100 is equals to US dollar this amount. So most of the currencies are coded directly in the terms of US dollar. So here we can also say that the direct quote is a different thing and the indirect quote is a different thing. Means buying selling rate, which we can say direct or indirectly, or here the fixed rate is the official rate which is set by the monetary policies or monetary authorities for the currencies. And under floating exchange rate, the value of the currency is basically decided by the supply and demand factor for that particular currency. Is that clear, that what is this? Now, so we can say here fixed rate is decided and controlled by the government or central bank, but floating exchange rate is not fixed. It changes based on what are the supply and demand, what are the inflation differences between the two countries. This India switched to floating rate in 1993, which linking the rupee to the US dollar instead of a currency basket. So bid and offer rate. Bid means buying rate, as I told you, buying rate. Offer rate is selling rate, which is also called as ask rate. So in the currency codes like US dollar, INR, this is given. So this is the bid rate and this is the offer rate. Clear? So now exchange arithmetic and the chain rule. What is the meaning of this? Exchange arithmetic and the chain rule. See, all the foreign exchange calculations are happening with too much concentration, and accuracy is required here. Even the decimals are should be correctly placed. So monitoring, evaluating is important to just reducing the chances of risk. And we know that markets are worked on very thin margins, so obviously if there is any error, that may wipe out the whole day earning and causes a good amount of loss. So that's why monitoring concentration is required when we are doing the calculations related to the uh, market. So what is chain rule? Chain rule is basically attaining or uh, doing a like comparison between two quantities that are linked another to another quantities. For example, I just saying that chain rule is also used to calculating the rates between the two currencies, but with the help of third currency. That third currency is US dollar. So chain rule is used to calculate the rate between the two currencies, and just because of third currency. So just to calculate this euro and INR, use this euro US dollar and use this euro INR and then cross them. What is value date? Actual date of settlement is called the value date, when the money is transferred and that money becomes effective. And in the TT payments, the value date is usually the same in both the countries. So if one side gets the money late, they may ask for the interest compensation. Then the money value date, the date of settlement. And what is the meaning of this chain, this TT transfer? That the value date is usually the same in both of the currencies, so there is nothing change in that thing. And uh, this percent or per mile means percent or per mile, both are different thing. Percentage is basically equals to 100, like one part is every 100, such as 1 rupee per 1 rupee we can say, and per mile mean per thousand, that is one part in every thousand. So that's we can say 1% is 1 out of 100, 1% in the case of per mile is 1 out of 1000. And for checking, for the rough calculation, for checking the margins, we use this calculation. So what is arbitrage in forex? Earning the profit by buying from one market and selling in another market at higher price. Suppose if someone is purchasing goods from this market, from Delhi, and then selling them to the another market at very high rate, that earning of profit, that is that case of profit is called arbitrage in the case of foreign exchange market. So there are types of arbitrage. We know that there are so many things, like in weekly market or in malls the things are costly in comparison to the weekly market or to the shops. So that case is the arbitrage in that the forex market. Now there are so many types of arbitrage: simple or direct. There is two marketing: purchasing from there, selling here in the other market just for the profit. Then 3 point arbitrage, which involves three currencies or three centers, and fast action is required because if the price changes quickly, profit opportunities disappears very fast, because here proper decision, proper action, and the fastness is necessary to just see the everything. So fast action is needed because price basically changes in very quick manner and profit opportunities disappears very fastly. So what are the rates in the different types of transactions? There are basically different types of rates, that is TT, bills, foreign currency notes, traveler checks, personal checks. If we talk about the TT, that is telegraphic transfer. What do you mean by this telegraphic transfer? What do you mean by telegraphic transfer? See, if we say that TT is the rate at which the bank buy the foreign currency from a customer, okay, or this telegraphic transfer is the rate or a type of wire transfer, we can say, in which transferring funds typically between different bank accounts, and this thing happens across the international borders. It is widely used for sending money overseas and closely associated with the SWIFT network. Okay. Now, traveler checks is like a cash type of thing. Like instead of handling the cash, they use the traveler's check. So that check will work like a cash. Okay. So here are some key takeaways. Like fixed rate means that is controlled by government, floating means changes with market forces, bid means buy, offer means sell, chain rules used to cross currency rates, value date is there for the actual settlement and the that is actual settlement date, and arbitrage means quick buying and selling to earn profit from the price gaps. Direct forex transaction means there are different rates. Now let's talk about the forex exchange dealing room. There are three dealing room: front office, mid office, and the back office. So everyone is functioning in their own way. Everyone is doing the work in their own way, and they are handling all the things according to them. It is a very special unit which is basically dealing in buying and selling of currencies, but it also manages the foreign currency funds, oversees the accounts, nostro, and sometimes trade the currencies just to make the profit. The dealing room works as a separate profit center for the bank, and banks are very serious with these dealing room because this is actually helps the banks in earning the things. So Forex dealing room operation comprises the functions of a service branch to meet the requirements of the customers. And Reserve Bank of India also saying that to the board of directors that should frame an appropriate policy and try to fix the suitable limits for its forex deal operation. So the major risk that are associated with foreign exchange dealing operations, where the management needs to frame policies and keep a constant eye, which can be like which due to this things become easy. Okay. So what are the key departments in the treasury management? There is a front office, that is the dealing room, the team that actually trading the currency, that is the front office. Okay, that team that actually trading with the currency, buying the things and selling the things. Then there is a mid office that handles the risk management and monitors all the risk and ensures that everything is according to the rules and the regulations. Then there is a back office which taking care of settlement, accounting and the reconciliation. Like make sure that all the transactions are recorded in the correct manner, because recording of the things is also an important thing. So that's why this thing, back office is taking care of all the keeping the records and all things, making everything clear. So that is front office, mid office and the back office. Now what are the qualities of a dealer? See, good skill must require, having the uh, having the knowledge of the skills, must able to work in pressurizing condition, good in taking the decision. So dealers are the people who trade the currencies in the dealing room. They must be quick decision maker, they can be able to handle the stress, they are responsible, they are ready to admit the mistakes. Their job is critical because even small errors can causes the big loss. So what are the two main position of a dealer? Funds position, mine, tracking the cash inflows and outflows. Like what is the problem in the inflows, is the inflows are greater than outflows. But if any mismatch is there, this thing causes the loss or missed interest income. Then the next is the net amount of currency bought or sold. So dealers manage this within the limits just to avoid this exchange rate risk. So now there is a concept of integrated treasury, which obviously this merging this domestic and the foreign currency. Why? Because there is interest rate deregulation, too much competition, and this thing will leads to easier exchange control rules. There is too much growth of forex market, there is better settlement system, and there is advanced trading environment. So that's why bank use this integrated treasury. What are the functions of the integrated treasury? It manages the reserves and investments in a optimum manner, it handles the liquidity and funds in a efficient manner, it manages assets and liabilities also, controls the risk which is related to the market and credit, it sets the transfer pricing, it develops and sells the derivative products. Like so many derivative products are the agreement, and also performing the arbitrage, where one purchasing from there and selling to the another market, also ensures good capital quality and the returns, and it also minimizes the non performing assets. That is NPA, so minimizing the bad loans also. So what are the RBI control guidelines now for the dealing rooms? RBI is there just to make give the guidance for the dealing room, and banks have to follow these rules, such as proper data system should be there, and there is a clear role separation. Like, everybody know that how this data is important. Then confidentiality is there, especially IT services are outsourced. If any IT service providing the services to the bank, so bank must sure that this IT service company keeps the data private. Also, setting the global limits for the interbank deals. Global limits, if any inter deal bank deals happens, so obviously it sets the global limits. Adequate capital should be there to manage any risky situation. Also uses the value at risk models just to measure the market risk. Regularly review that risk models are working properly or not. Dealer have to follow the limits on the trades and the stop loss, and there are limits on the counterparty exposure, country risk, and some overnight open positions. And there should be monthly evaluation of the forex market, which uses the RBI approved rates. So monthly evaluation should be there for the market. Like, everything should be monitored, everything should be checked, everything should be reviewed. So if there is any problem occur, so it will be like monitored. Clear? Okay. Okay. How to manage this dealing room? Clear separation of the functions is there. Front office doing their work, own work, they are trading the buying and selling the securities. Mid office is doing their own work, they are doing risk management and doing check on the compilation, like everything is according to rules. Then there is a back office, which is settlement, accounting, and the reconciliation is there. Dealers must be well trained, and they are able to work under pressure, which is making the fast decisions, and they are handling the risk. Whereas large bank, they are investing in the technology, they have the specialized team, they have their skilled teams for different types of products, to just maximizing the profit while controlling the risk. So what are the risks that are that contained in the Indian banking dealing room? Banks in India, they are having the large dealing rooms, which manages the various types of forex products. As it is allowed by the RBI, some important risk controls include: dealers must know and stick to their assigned trading limits. Dealers know that uh, that how to stick their how to be in their trading limits. All the deals with the counterparties must be their appropriate limit, right? And there are some daily operate overall trading positions must be approved within limits by the bank of board. Like, just a second. See, there are daily overall trading positions are there, which must be approved within limits by the board of. But there are so many limits which are everyone is uh, everyone is working according to these limits. Okay. Now they monitors the mismatches in the maturity date and do the trading positions carefully. Okay, so there are regular checks. They evaluate the profit and losses from the forex trading. Then they reconcile the bank accounts, like such as nostro and vostro accounts monthly. Okay, they checking the things clearly. They have to do all the things according to the limits and according to these rules. So they confirm the balances regularly with the correspondent banks. So correspondent banks is a different concept. You can see these are included in the international banks also. So there are so many risks that are controlled, and some important risks are in which dealer have to take care, in which the buyers have to take care, in which the parties have to take care. These things they have to reconcile everything, they have to monitor everything, they have to check everything. So these are the things here. So how, what are the introduction, how derivatives are introduced here? See, derivatives are those financial contract whose value depends on the underlying assets like currency, stock, commodities, or the bonds. They just help the companies, and bank here manages the risk or speculate just for the profit, because every bank is there just for the profit. There are some common derivatives which include forward, future, option, and swaps. Then foreign currency futures, like a standardized agreement that are basically traded on the exchanges, where people can buy and sell the currency at a set price, but there is a future date. Like, they are the agreements which are there traded on the exchanges to buying and selling the currencies, but there is a set price on the future date. So what are the key features? They are traded on the regulated exchanges like Chicago Mercantile Exchange. Prices are set according to the supply and demand. Contract have the fixed size, delivery date, and other standardized terms. Settlement can be physically or in the cash settlement. Clearing houses here guarantees the trade and manages the credit risk through the margin requirements. Clear? Then forward contract means these are the private agreements. These are very private, not transparent, not disclosed to anyone. These are happen between the two parties to exchange the currency at a fixed rate on a future date. It is usually used mainly by the exporters and as well as importers to protect, to get the protection against the currency risk. There are so many characteristics, like this is customized contract terms. This is typically used for 1 year, but this can be used for longer now. These are not traded on any type of exchanges. This require documentary proof of the underlying trade. This can be settled or cancelled on maturity with profit or loss adjustments. Then the option contract. Option gives the buyer the right. Option gives the buyer a right to buy or sell the currency at a fixed price before a set date. So there is an option gives the right to a buyer but not any obligation to buy or sell the currency. There are two types of option: call option, where we have the right to buy the things; put option, where we have the right to sell the things. So buyer here pays a premium to the seller for the right. Buyer here pays a premium to the seller for this right. Okay. Now some important option terms are there. Strike price, that is called a fixed price at which the currency can be bought or sold. Premium means cost of buying the option. Spot rate is current market price, and options can be American, options can be European. Like American mean which can be exercisable anytime before the expiry, and European means exercisable only at expiry. Option status means at the time, at the money with where the strike price is equals to spot price. In the money means the profit if they are exercised now, and out the money means not profitable if exercised now. Okay, so what is the role of RBI in this forex market? How RBI there are two parts. Today we are going to cover first part, in which we are going to cover the module A and module C, and then tomorrow we are going to cover B and D module. Good morning, ma'am. Good morning. So RBI role is there in the forex. RBI role means RBI is India's central bank, and it is basically having the custody of foreign exchange reserves. So it sets the rules and also the guidelines for the banks and the other entities to deal in the foreign exchange. There, the RBI work is just to do the guidelines. Okay, so it sets all the rules and the guidelines for the banks and other entities to deal in the foreign exchange. And FEMA 1999 and its regulations says that how these individuals and companies have to handle these foreign currency. So RBI is just focusing on everything is going good, everything will be according to the rules and regulation. They guides the banks, they telling that bank that these actions are necessary. And FEMA is also there. So many other regulatory organizations are there with the RBI who are helping in forex exchange transactions and advising the banks. Authorized dealers, see, authorized dealers are those persons, those institutions who are having the license from the RBI. They can officially handles the foreign exchange transactions. Okay, so RBI give licenses to the authorized dealer, and these authorized dealers are carry out this foreign exchange transaction. There are basically 95 authorized dealers which include public and private bank, foreign banks, some financial institutions, and there are some categories of the authorized dealers. According to the categories, everything is divided. Like category 1 is there, authorized dealer category 1. They are the top level of authorized dealers who can handles all the transactions related to the current and capital account transactions. They can handle every type of foreign exchange transactions. Suppose example is are there commercial, state and urban cooperative banks. Basically this is the top tier, top level. Then there is category second. They can deal in non foreign exchange transactions only, like some FMC, regional rural banks, cooperative banks. Then category third, these handles the foreign exchange transaction but related to international trade financing only. So there is the example, export import bank and the CAIIB. So what are the money changers? Who are the money changers? See, RBI say I am issuing the licenses to the firms, hotels and the shops. So they can help the bank in dealing with the foreign currency notes and the traveler checks. So people and tourists will come to them and they help them to exchange the foreign currency notes as well as some traveler checks. As I told you, traveler checks act like a cash. Basically tourists hold them, travelers hold them, just to see that everything is, they don't need to handle the cash, because handling the cash is much risky, and they handles the traveler's check instead of cash, and these traveler checks act as the cash. Then there is a fully fledged money changers, which are basically authorized to buy and sell the foreign currency. These fully fledged money changers, these are authorized to buy and sell the foreign currencies. Then there are restricted money changers. These are authorized only to buy the foreign currency. Okay, restricted money changers, these are authorized only to buy the foreign currency. Clear? So there are some money changers also, and they help the in which they basically help the RBI in joining the things. Now FEDAI, self-regulatory organization, comes in 1958 with the RBI approval. It helps in regulating and supporting the foreign exchange markets in the India. All the authorized dealers have to follow these FEDAI guidelines. All the authorized dealers, they have to follow these guidelines. What are the objective of this FEDAI? This works with the RBI, so the internal external, India's external basically trade center grow. It supports the promotional councils and the chambers of commerce. It develops and improves the foreign exchange market. It promotes the best practices among the authorized dealers. It creates the uniform rules to ensure that there should be fair competition and cooperation. Okay, so these are the objectives of the FEDAI, that basically helps the RBI to regulating the authorized dealers and the foreign exchange transactions. Okay, so what are the role of FEDAI? This act as a RBI, this act as a bridge between RBI and authorized dealers. Okay, it acts between a bridge between RBI and the authorized dealers. It issues the guidelines on forex trading and handling the export import bills. It issues the guidelines on the forex trading and handling the export import bills, and it represents the India's position in the international trade rules discussions. It represents India's position. Then provide the training to the bank and the forex trainers or the forex dealers, sorry. It monitors the forex brokers and the intermediaries. It administers the important benchmark exchange rate with where the calculations like NOOP, value at risk, is calculated. So basically FEDI is also helping the RBI just to guiding the bank, and that is very important. You can see how many things are managed by just this FEDI. Then let's talk about the LRS, liberalized remittance scheme, in which we are discussing about first the capital account transaction, that is under the section 2 subsection E. What is a capital account transaction? This is one that changes the assets or the liabilities outside the India, that is basically changes the assets or liabilities which are outside the India. Suppose any person who is living in India and they are making the asset abroad, that is come under the capital account transaction, but these transactions should be according to the LRS. And that person is making the assets or liabilities, person who are in India, of a person resident outside India, or of a person who is resident in India. Then what is current account transaction? That comes in section 2 subsection J. A current account transaction is that transaction which is other than a capital account one. So helping the people who are in living abroad, that those are close relatives, and some peoples who are there in the market, like in the India, and their close relatives are outside India. They want to send money for their education, for their maintenance of public, maintenance of family, sorry. And then here we can say some type of they want to travel abroad. So lots of things are there which comes into the current account transaction, and also they are paying the interest on the loans on the earning income from investment abroad. Okay. So this is the meaning of current account transaction. Okay. So capital account transaction, I told you, like making assets outside of India, or making assets in India from the people who is living outside the India. So same as current account transaction, that is a transaction which is other than the capital account transaction, like sending money for the maintenance of family, education, travel and medical treatment, that all the things according to the current account transaction. Then subsections are there, some sections which are related to the LRS. Section 4, holding the asset abroad. A person cannot hold any foreign exchange, any securities, any property outside the India unless it was acquired while they were a non-resident, if it is permitted under the FEMA guidelines, unless I am saying here. So under the LRS, investment can now invest abroad, and there are certain limits. Within the certain limits they can invest abroad. Okay. So then section 6, what is section 6 saying? There is permitted capital account transactions where individuals are just allowed to buy and sell the foreign exchange through the authorized dealers. Individuals are allowed to buy and sell the foreign exchange through these authorized dealers for the permitted capital account transaction. Here the RBI decides what type of transactions are allowed and up to what limits. Then there is misuse of foreign exchange. Suppose if any person is traveled to Europe and uh, then come back to the India and having some currency of Europe. So in that case, he thinks that why I return the money to the bank, I keep this money just for my memory. So that person did not return any money to the authorized dealers or the bank. So when bank know this thing and this person fail in returning the money in the used time, so that means that person considered that person have broken the FEMA rule. So there are section 10 is there for these type of dealings. Then there is compliance by the authorized dealers. Authorized dealer have to follow all the rules by the RBI, like how to handle the foreign exchange transaction, what information is required to be collected and reported. Penalties are there up to 10,000 and 2,000 per day if the issues are continued, which can be imposed if they don't follow any type of procedure. So there are some penalties or violations also in the section 13 if someone violates the FEMA rules. So the what is the penalty? 3 times the amount involved. Suppose if someone do the violation of 1 lakh, that means 3 lakh will be charged. If this thing is not calculated or not predicted or not assumed or not calculated, so in that case 2 lakh is the fine amount and 5,000 rupees per day for the continuing contraventions. Okay, then this FEMA is a rule that ensures that all the foreign dealings are regulated and monitored properly. It protects the Indian economic interest and also ensures that residents have to follow the correct procedures while dealing in the foreign exchange or sending the money abroad. Clear? So that is the conclusion for the FEMA rules. Like FEMA is basically ensures that all the foreign exchange deals are regulated and monitored properly. That's why FEMA is there. Obviously, FEMA work is that just to protect the India's bank, just to protect the foreign exchange market, just to protect the things which are creating causing cause for the banks. Thank you, S. Kumar sir, for your words. And yes, you are saying right. For the capital account, there is TUI. You say right. So now see, in LRS there are three schedules: Schedule 1, Schedule 2, Schedule 3. Schedule 1, where the remittance is not allowed. This is the prohibited sector. Like if the commissions are there on exporting for investing in joint venture, there is payment for the callback services, buying the banned or prohibited magazines, buying the foreign currency convertible bonds, buying the dividend from the companies where dividend balancing is required, interest income for from non-resident special rupee account, money from lottery winnings or to buy the lottery tickets, income is from the racing, riding, hobbies. There is a commission on exports under the rupee state credit route. Schedule 2 is saying, okay, remittances are allowed but needing the government approval. So you can see there are different purpose and departments are mentioned who are giving the approval for that case. Then schedule 3, that is remittances allowed for the resident individuals where no approval is needed. That thing is okay, this thing you can do under the LRS. So basically private visits anywhere we can visit because we have the right to freedom, so no one can't stop us. We can do private visit, but that country should not be Nepal or Bhutan. We can do the give the gift, we can do the donation, we can go for abroad just for doing work and earning the money. We can do immigration, moving permanently to any other country. We can do the maintenance of close relative, these close relatives who are living abroad. So business travel, traveling as an attendant for a patient who is having the treatment abroad, medical treatment abroad, studying abroad, buying the artwork, other payment like health insurance abroad. So some operational guidelines under the LRS. See, PAN card is mandatory whether the remittances is of 10 rupees or 10,000. PAN card is mandatory. You can send money abroad for the permissible current account transaction and permissible capital account transactions, and you can do remittance for both of mix of both. You can send up to $250,000 per financial year. Financial year starts from 1st of April and ends on 31st of March every year. No limit, like if you want to send 10 rupees 10 times, 100 times, but this limit should be under 250,000 US dollar, 250,000. Person have to choose one bank branch only for capital account transaction. Now bank responsibility that they will make smooth process for the customers within the rules. If the sole proprietor, like an individual owner of a business or a shop or any type of thing, they wants to send abroad a money through a firm account, so the individual limit applies. And the foreign nationals who are living in India, except Pakistanis, they are for short term jobs, they also remit under the LRS, but after all the taxes and deductions. International debit credit card we can use, ATM card we can use for the current account transactions. Then new customers are there. If a person is new to the bank and wants to send the money abroad, so bank have to check all the proper evaluating that person, and then bank will ask show your past statements, show your ITR, and show that from where you are earning. So bank have to examine that how money is coming and how money is going out, and see that is there any suspicious transaction available or not. So what type of documentations required? RBI is not mentioning any specific type of document that RBI makes a list of documents that I need that type of documents, but it is according or up to the authorized dealers. They can demand any type of document. Basically they demand form A2, that is the declaration under the FEMA, and submission online available. Simple documents. If bank is satisfied, that is okay. If not satisfied, they will ask for some simple documents. There is a declaration of source of funds to confirm where the money is coming from. So PAN card, which is required for all the remittances. Confirmed ticket and visa, which is for travel related remittances. Through the tour operators can collect the money in the INR or foreign currency. They can also open the special foreign currency accounts in the Indian banks. Like tour operators, they can collect the money in the INR or the foreign currency. See, tax collected source is also there. See, there is a changes in the tax collected source. So this thing keep in your mind. This we know that 7 lakh we have to deduct, but now this increased to the 10 lakh. Okay, so just keep this thing in your mind that this limit increased up to 7 to 10 lakh now. Now 3 lakhs are increased. Okay. Yeah, 5% is there with that PAN card, but without PAN, this 5% TCS become 10%. If someone wants to do the private visit, except Nepal and Bhutan, they can take that cash of 50,000 directly. But more than this, then money must go through to your bank account. Foreign currency notes are allowed according to the currency wise limits. If you don't use the full foreign exchange, so you have to give back the money in one within the 180 days when you return back to the India, so you have to surrender that money. Sound is very low. Now it is okay. I increases the voice. I hope that it is okay now. So where I am, yes, I just saying that 10 lakh is not implemented. I'm just giving you the news that should be know. So there is a private visit thing. Now see, there are some cash limits in the foreign currency notes for the Hajj pilgrims. This is according to the Hajj committee rules. Iran, Russia, full amount in cash allowed. Iraq and Libya up to the US dollar 5,000, and all other countries there is up to the dollar 3,000. That is the foreign currency notes limits in the different cases in the for the Hajj pilgrims. That thing is decided by the Hajj committee. And Iraq and Russia, that thing is basically in the case of Iran and Russia, full amount is available. Iraq and Libya only 5,000 up to dollar US dollar 5,000, and all other countries there are up to US dollar 3,000. Okay. Now, if I want to gift someone who is outside India, I can send abroad gift to my relatives as per the Companies Act 2013. Relatives means any like spouse is there, husband or wife. Parents are there. If the parents are steps, they are also included. Children, siblings, and their spouses. Gifting the foreign currency, I can't gift the foreign currency. I can't give the securities to another resident Indian who are living abroad. I can make donations, but this limit should is there in the case of donation also. And in the case of donation, I have to make proper documentation and I have to explain the proper purpose of my donation and everything about related to the donation. Okay. So that does not mean doing donation is easy way. I have to make the proper statements. Then there is the process of emigration. What is the emigration means? Where emigration means I can remit the foreign exchange up to US dollar 2,50,000. If someone is suppose some people is any people is moving permanently to another country, so that person can remit the foreign exchange for US dollar 2,50,000. But if that country needs more than that amount, so you have to show the proper documents. you cannot invest in the foreign business, you can't invest in lands, bonds, just for qualifying as a immigration. And foreign bank guarantees for the jobs or immigrations are not allowed. Now if somebody going abroad for the employment, so that person is also remit this amount of money only. And you can also send for living expense of a close relative like parent, spouse, sibling. Purchase of art for personal use is allowed, limit is same. Business trips are allowed. And but suppose if a employers taking all the expensive of that business trip, that in that case LRS does not apply. Medical treatment abroad up to US dollar 2,50,000 is allowed, but if in case the medical treatment needs more money, so in that case doctor estimation is required for more money. Okay. And whoever the attendants of the patients, they also need they also have the limit of US dollar 2,50,000. If someone is studying abroad, that person is also having the limit of US dollar 2,50,000. But in case if that person needs more money, more than US dollar 2,50,000, so in that case they need the estimation from the university. They have to show the that estimation to the India, and then they can remit up to US dollar 1 million from their NRO account. And if there are funds are from Indian income, like if the student become NRI under the FEMA, because there are two types of NRI definitions are there. One is according to the FEMA, one is according to the Income Tax Act. So tax collected at source, there is 5% applicable on the remittances above 7 lakh. This 5% become 10% if no Aadhaar card, PAN card is there. For education, only 0.5% is there if the loan amount, if the remittent amount is above 7 lakh. So this tax is only for the LRS transaction, not for any business import or any remittances by the companies. So capital account transaction under the LRS, what you can remit? You can remit the foreign currency accounts abroad. You can remit the money for the buying property abroad under the LRS. You can invest in shares, mutual fund, bonds, quantification share for directorship. You can share, you can invest in the shares which are as a remuneration. You can set up the joint venture and wholly owned subsidiary. You can give loans to the NRI who are very close relatives. What is thing not allowed? Any person can't invest in real estate business and the banking or financial services, foreign bank guarantees, and gifting to the other residents who are living in the foreign currency. Like other people gifting the US dollars, that is thing is not allowed. Obviously always use one branch for all the capital transaction. Then the account should be active with the branch for at least 1 year. Joint ownership is allowed, but remittance should be from multiple family members. ODI, overseas direct investment, means there is a investment which is outside India, which is in the outside India, investing in any joint venture or wholly owned subsidiary, like investing the money in the company's capital, subscribing to the memorandum of association with which includes all the rules and regulations of the company, buying the existing shares, whatever the shares are existed, just buying them. Who can invest? Residents can invest alone, but also can invest with other people, but they have to follow some rules are there, they have to follow these rules. Okay. what are the prohibited investments? Can't invest any joint venture or wholly owned subsidiaries. For the real estate business purpose, for the banking business, or for the financial service. Investment limits are can't exceed this amount. Banks accounts abroad. Investors can't open bank account abroad to manage these investment. And there are family investment, like family members can pool their limits if they are the co-owners, co-partners, or the overseas investment. Okay. So what is the meaning of correspondent banking? Suppose there is a bank in the India, bank A, having the customer in the USA. Okay, having their customer in the USA. Now this bank wants to connect these customers. So what this bank will do, will contact the Bank of USA, just serve my clients on my behalf. Bank USA say okay, I can do that. So that is the condition of correspondent banking, where a bank which is called a correspondent bank provides services to another bank, that is the respondent bank, in a different country. So these services, due to these services, banks can carry out the international transactions, like can do wire transfer, document collections, and the payments, especially when they don't have their own branches abroad. It is like having a banking partner in another country who can handle the business on your behalf. So why we needed this? Not all the banks have a global branch network. Why? Just due to the cost and the government regulations. Obviously that is not possible for a bank to open the bank set up everywhere, bank branches everywhere. That is expensive, that is also not possible, just because of some government regulations. So it helps in supporting the international trade and the remittances. It serves the NRI and expatriates better. It provides the banking services in foreign countries where the home bank has no presence. It ensures there should be low cost access to the foreign market. What are the services that are provided to the correspondent bank? Handling of trading the documents and the international business transactions, depositing the collection, doing the fund transfer and the local clearing, and also it has act as an agent of the respondent bank in the foreign country. So services that are provided by the correspondent banks are like so many things we can say. Now FATF is Financial Action Task Force that helps in preventing the money from money laundering and for funding for the terrorism activities. So cross border correspondent banking is considered high risk because there is obviously the risk of money laundering and for the anti like money laundering, and the risk of anti funding of funding for the terrorism services is may be present there. But this FATF recommends that prevents the money from money laundering and for any terrorism financing. No simplified checks are there for the cross border relationships. So bank should avoid partnership with those institutions that do not report large transaction or lacks the transparency. Like bank have to take care of this thing, that like residents, individuals, they can invest, they can basically, banks have to take care of this thing, that they are not doing any type of business, any type of partnership with those banks which is problematic. Yes, we can say that CB is not providing the credit facility. Apart from this, providing all the facilities. So, what is the importance to India? Obviously, there are so many peoples who are living in India, who are working abroad. They wants to send money. They obviously they send money to their home, but this thing help in making the India's foreign exchange reserve stronger. So that's why there are so many banks in India which offers the services to the NRI with the support of correspondent banking abroad. This thing will increase the exchange reserves. What are the function of correspondent bank? Correspondent banking means there is a one bank which provides services to another bank, usually that is in the different country. These services are especially useful for the international trade and money transfer. So what are the services are there? They can handle the payment that go out, that go out or come in for the respondent bank. Then they can send and receive the payments. They can also reimburse the money under the letter of credit. They collect the checks or the drafts. Okay, they collect the checks or drafts. They give the account statement and also do the transaction reporting. It also offers the some type of temporary type of credit line during the day, and they will wait that funds will arrive at that time. So that is not a big problem in that case. Then okay, it helps in collecting money for any export and import, checks and bill of exchange. After collecting, the money is credited to the respondent bank account. They may also remind people to pay, protest unpaid bills, take steps to protect the respondent bank interest. Special facilities include here cash letters, so to collect the check faster, lock boxes where the clients can drop the checks to speed up the collection. So there are so many facilities available for the banks, so they can do their things easily. Now correspondent banks carries all the payment instructions from the respondent bank. Payment could be to the other banks, payment could be to the customers, payment location could be local or international. So overdraft or loans, like if correspondent, if anybody needed, so correspondent bank is available for the temporary overdraft, for the overnight basically. It may also offer short term loans based on trust and agreement, which require proper agreements as well as some type of regulatory approvals. Okay, um, just take 5 minutes break, then we will move to the next concept. I need just 5 minutes break. There is module next 3 chapters. Okay, just need 5 minute break. Okay, so let's start now. So, uh, let's talk about the investment services. I hope my voice is coming. Let me check this. Okay, so the investment services, which helps us in investing the things kept in account overnight for one night only, for the short period, one night only, or that will be for the short period. Okay. So they may offer the interest on the surplus funds, like obviously there will be interest for the surplus funds, and there they allowed the short term deposits, they allowed the cash management services, all the services related to the cash management. That thing is available in that case. They offer these things in the case of investment services. So there are so many things available just for doing everything will go smoothly. And other services, these services does not need the respondent bank. Means in the case of some services, that does not mean that respondent bank will be available every time just for open an account with the correspondent bank. They depend on the relationship and the credit trust between the banks. They know that we do the agreement, then they trust on that agreement, they don't check everything, that they believe that if we hire the correspondent bank, that they will be responsible for all the things they are doing, their services providing, that they are that some services are like advising for the letter of credit, like informing the respondent bank about issued LC in their favor, LC confirmation, that guaranteeing payment in this, because there is a chapter of LC. LC is working as a trust agreement where banks interfere between the exporter and importer. Buying and seller credit, which helps the importers to get the credit for the international purchases. Obviously, there is a chapter which is facilities available for the exporters and importers, so they will help the importer and exporter, uh, whatever the services, whatever the help they can provide. And also they are assisting with the trade related payments. If anybody need the payments, and they will do check everything related to the payments. They also issuing the guarantees, they also issuing the guarantees for the trade contracts. And some foreign exchange services are also included there, custodial services, like thinking about the safeguarding of securities or some financial instruments. They safeguard all the things, they provide the shield for that things also, because they know that risk are available in that cases, and everyone is doing their business for profit only. And they share the information about the companies also in other countries, like they are interested in sharing the information that companies is doing this thing, companies uh, doing that type of investment. Some investment services are also there, they are helping with the overnight funds, they are helping with the securities, they are helping with the short term deposits. And some fundraising services are also there, they are assisting, they are advising that how to raise money in the possible manner through the bonds, ADR and GDR, these American depository receipts, and GDR is global depository receipt, we both are the siblings. And trainings and seminars, they offering the learning sessions on the new trends and on the new topics, just to make sure that everyone is aware about the new policies, about the new updates, and about the new amendments. If there are any amendments or any changes are there, they will explain everything to everyone, so everyone know that what is going on. Then nostro, vostro, loro and mirror account, the most important accounts, basically the nostro and vostro and loro. And obviously in the case of international banking, these accounts are there just to helping them. And they will handle the foreign currency transaction, helps in handling the foreign currency transactions. These accounts are known as nostro, vostro and loro account, which is depending whatever the perspective of the bank. These accounts are helps the banks. So what is nostro account? See, SBI Bank is there, which is maintaining their US dollar account in Citibank. Citibank is in the New York, suppose. So this SBI handling the US dollar account with the Citibank, that is called the example of Nostro account, which is basically our account with you. Means India's account with any other country which they are handling the foreign currencies. So bank holds this account in another currency with a foreign bank. Then there is a Vostro account, that means your account with us. Okay, it's my chance in the case of Nostro account that I want help from another country bank account. So Vostro account means in for the humanity, obviously they will offer that your account with us. So foreign bank account and holding in our country, home country, in the home currency. So if Citibank wants account in SBI Bank, they will open the rupee account, that is called is the example of the Vostro account. Then Loro account. Loro account is like their account with them. Means account of another bank for the viewpoint of third party. So third bank is also included in there, like Citibank offers the rupee account of American Express with SBI. So other bank account with the SBI, and taking this account is monitored by the Citibank. So that is basically a case of third party account. So this is the example of Loro account, Nostro account, our account with them, Vostro account, their account with us, but Loro account, their account with them. In this case, the third party enters. Okay. Now, SWIFT, one of the trustable Society for Worldwide Interbank Financial Telecommunication. There are 11,000, over the 11,000 banks are connected in 200 plus countries. One of the secure financial messages happens just because of this SWIFT. SWIFT is not about the car, that is Swift Desire or Swift, that is a different thing which helps in handling all the messages in secure way. It operates 24 into 7, available every day, and offers the cheap transactions, cheap things. Then there is a old system Telex, cheaper than Telex, one of the most popular one. And this used our relationship management application, or BIC, that is bank identifier code, for the authentication of the messages, that everything every message will conducted, communicated between different banks. It is just used for the bank to bank payment, trade finance, and the securities for securities and the forest transaction. That is basically used for this. There are so many types of types, like Swift, like Fedwire, Target. So many things are there. We will learn about the chips, like not Lay's chips or the Uncle chips. This is clearing house interbank payment system, which is most famous in the USA, based in the New York, used for the US dollar payment, net settlement system, and payments are settled in bulk in the end of the day. In this, basically bank gets a UID number for easy processing. So every transaction will process easily and with a different UID number, and mostly used for the foreign exchange and the large US dollar transactions. If there the transactions are in the large, it contains the large US dollars, so that's why chips is used in the USA. Then Fedwire, chaps is also there. Fedwire is also based on the USA network, and it is run by the Federal Reserves for domestic US payments. It is worked in basically RTGS basis. It is used for interbank transfers. It is used for the local banks by the commercial payments, used for the commercial payments, and also helping in some securities payment. And it helps over 9,000 participants, having the more than 9,000 participants. Now chips is clear, USA based. fed by USA based. UK is saying I have also chaps, UK version of chips. They named them as chaps. It used for pound sterling payment in the UK and help about 20 member banks and 4,500 indirect users. Then there is a target 2 Eurozone RTGS system, that is Trans European Automated Real Time Gross Settlement Express Transfer. Not that much famous, but for euro transaction this is one of the greatest initiative. It is mandatory for any central bank operations that are doing their work in the eurozone. Like in India we have RTGS and NEFT. So in Germany there is RTGS plus. RTGS system having the 90 participants, more than 90 participants, used in Germany and some other parts of Europe. Then there is a EBA clearing. EBA clearing means this is a type of basically EBA clearing is a includes some euro 1, that is a netting system and for the cross border payments, and step 1 for the retail payment, and step 2 is there for the automated clearing and straight through processing. Means everything is happen in the Europe or the Germany, which helps in the cross border payments or for the retail payments. So 200 plus banks are using it and they are doing well in that EBA clearing. At the end, payment is mandatory. Settlement or payments on time is obviously important for everyone, because if I sell anything to any person, so my first concern is just about the payment. So that's why banks thinks that this thing is very important. Now the next thing is RTGS and NEFT in India. So if we are talking about the India, so there are two system, RTGS and NEFT. We usually use this thing when we want to transfer the money from one bank to another. So there are two systems which are majorly used, RTGS and NEFT. Both have their own advantage and both are operated by the RBI and they help the customer. So customer sends the money quickly and in a very safe manner. RTGS is used for basically large payments, and in this payments happen immediately, payments settled immediate basis. That's why the name is real time means the money is transferred immediately, and gross settlement means every transaction handled in that case one by one individually, not in batches. Because if we talk about the NEFT, in NEFT things are payments are settled in batches. In this at least 2 lakh is needed. In the case of RTGS, minimum minimum amount is 2 lakh, but amount below 2 lakh we can't use the RTGS. No maximum amount you want to send, 5 lakh 10 lakh you can send. It is available 24 into 7, 365 days, and since 14th of December this becomes available 24 into 7. And then every bank have to maintain their pool account with the RBI for these RTGS transactions. It is managed by the IDBRT, which is in Hyderabad, Institute for Development and Research in Banking Technology. So obviously IDBRT help all the things related to the RTGS transactions, and within 30 minutes if any person have done the RTGS transaction, they will receive the things, all the things are settled within 30 minutes. Basically immediate basis, but maximum time is there for 30 minutes if there is any server issue or any net problem or anything. So everything will handled settled in 30 minutes. So if you want to transfer 5 lakh by using RTGS, so money sent instantly, receiver should receive the credit message instantly or within 30 minutes. Then NEFT, National Electronic Fund Transfer, used for any small amount if you want to send, work in batches. suitable if someone wants to send money on the regular basis or for the low money transfer. No minimum account, no maximum amount. If you want to send 10 rupees, if you want to send 1 lakh, you can send. You want to send 1,50,000, you can send. But in the cases of 2 lakh, we have to use the RTGS. It is also available 24 into 7, 365 days, which includes weekends and holidays. That does not mean if today is Eid, so we can't do the NEFT transaction. We can do in the case of Eid, in the case of Christmas, Diwali, any holiday, we can do it. Okay, so today is a double celebration. Eid is there and also weekend is also there. So NEFT don't work occasionally. It is available 24 into 7, 365 days. It is the settlement happens every hour, and now they are happen in every 30 minutes. Why? Just for the faster services. Okay, that is transfers after work, after the banking hour. Like once the banking hours are done, that are using the STP, that is automated process systems. Okay, so that is about the NEFT. That is about the NEFT. I'm saying about now. I hope that clear both the system RTGS and NEFT. If any doubt you are having, please ask me in the chat box so I can help you out. So there is a comparison of RTGS and NEFT. You can see the comparison. That comparison is just for the better understanding, because questions is from there also, from the RTGS and NEFT, because these are Indian based systems, so it is important. So one thing is, you have to keep this thing in mind. RTGS for the larger transaction, NEFT is just for the minimum transaction, less than 2 lakh. Now why these are important? Obviously, for the cheaper settlement, for the faster settlement, they charge some money, but cheap transactions are there. They supports the Indian digital system and also the financial inclusion goal. You know that digitalization is there in the market nowadays. Everyone is using the UPI, everyone is using the uh, payment system. Like you can see, if you want to book the tickets, if you want the pay the bills, if you want to transfer the money, you can use this. Digital banking is having another topic which is also included in our module B. Financial inclusion means everyone have to use banking services, and banks using this financial inclusion, just whatever the person is living in the rural area, whatever the person is living in the urban area, they all know what are the importance of the banking services. Okay, so that is why RTGS and NEFT important. Now NRI, who are the NRIs? What is the meaning of the NRIs? See, I told you this thing. NRI have two definitions. Okay, one is according to the Income Tax Act, one is according to the FAMA. They both have the different perspectives for the NRIs. In Income Tax Act section 6, a person is a resident. A person is a resident if that person stayed in India for 182 days or more in the previous financial year. Suppose current the financial year is starts from 1st of April 2025 and ends on 31st March 2026. So in 2024, that person is there in India for 182 or more than 182 days, so that person is considered as NRI, sorry, resident. But second condition is that if this condition is fulfilled, or that person is there for 365 days in the last 4 years, in the last 4 years plus 60 days also, in the previous year at least 60 days, for 60 days that person is in India, so that person is also considered as resident according to the income tax section 6. If these conditions are not fulfilled, so that person is obviously considered as NRI according to the income tax act. But there is an amendment from 1st of April 2020. If that person is there in India for 120 days or more and lived in India for 365 days in the last 4 years, and having the income earning 15 lakhs or above 15 lakhs from the Indian sources. Now Indian sources can be rent, dividend, so that person is considered resident, but only for the tax purposes. That person have to give the tax in the according to the income tax act, so that person is eligible for income tax. So now some other categories also included in the income tax, that is resident but not ordinarily resident. Like if any person stayed 9 years outside the India, out of 10 years, 9 years outside the India, that is person is called RNOR. And if a person stayed less than the 730 days in the last 7 years, or that person is a Indian citizen or with the over 15 Indian lakh Indian income, and stayed in India for 120 days in the previous year and 365 days in the last 4 years, that person is also is a RNOR but having the income of 15 lakh. So according to this, it is eligible for tax purposes. But who is deemed resident? Who deemed resident means if there is an Indian citizen who is earning 15 lakh or more than 15 lakh, if it is not a tax resident of any other country, they are treated as resident for tax purposes. Like that person is not eligible for any taxable income from any other country, so that person is treated as resident only for the tax purposes. Even if they are living abroad, if that person is living in USA, Germany or any other part of the country of the world, so that person is considered in India as a resident, tax resident. But income should be more than 15 lakh or 15 lakh. But according to the FEMA, who is NRI? FEMA is saying, according to me, NRI is a different thing. A person who is living abroad or already a citizen of India, but that person is in the abroad for employment basis, for the business purpose, for the study purpose also. So, or any person who that we don't know the stay of that person, tenure of stay of that person, so that person is considered as NRI. Indian diplomats, government employees, or people who are working in the international organization like United Nations, World Bank, IMF, these all persons are considered as NRI because they are already doing jobs in other countries. So that does not mean according to FEMA they are considered as NRI. Okay, that like these persons are considered as NRI under the eye of FEMA. Clear? So who is POI? POI, person of Indian origin. They also having the different condition. They are not the citizen of Bangladesh or Pakistan or any restricted country. That country which is restricted, that person was a citizen of India in the past, citizen of India, whose parents, grandparents, great grandparents were the citizen of India. So that person is also considered as NRI. Who is married to the Indian citizen or a person of Indian origin, so that person is also called as person of Indian origin. That includes the overseas citizen of India card holders. So basically there are different categories. First one, NRI according to the FEMA and according to the income tax act, then RNOR, then PIO and deemed resident, and every one have different conditions. So if any student goes for higher studies These are also considered as NRI by the RBI. Even they are staying abroad, or they are not staying abroad permanently. So, but for currently purpose, they are considered as NRI. Tourists who are visiting abroad for a short period, they are not considered as NRI. Suppose if uh, um, X Mr. X is there in abroad for just traveling purpose, so that does not mean that India consider that Mr. X as a abroad person or a NRI. No, that person will not considered as NRI. There is a foreign spouse of an Indian citizen, or any person of Indian origin, that person is also treated as person of Indian origin for the purpose of banking and investment in India. So why NRI important? NRI banking is important. Why? Just because to help the NRI so they can open their special bank accounts. They allow them to send money to India easily, because obviously if someone is going for the employment purposes, that does not mean their whole family is there in the abroad. Say that person have to send money to the India. So that's why NRI banking is important, and it helps the India to receive the foreign exchange, which strengthens the economy. Okay, it helps the India to receive any type of foreign exchange, which obviously give push to the Indian economy, and offers the investments and tax benefits to the NRIs also. Overseas corporate bodies means these OCBs are basically those companies which are outside India and managed by the Indian citizens, or some NRIs, for having 60% or more percent of shares held by the NRIs. They were once allowed to invest in India just like NRIs. Once they are allowed to invest in India, but from 16th of September 2003, RBI is saying that we don't want these OCBs as eligible investors. Because of this, OCBs can no longer make fresh investments in India. Now this thing is prohibited in India. But if there is an old OCB, they wants to invest now, so that basically must not be in the RBI caution list, because RBI caution list is there, which contains all the error type of investors, and in that case they have to take the approval from the RBI. Now, okay, NRI banking, we know that there are too many types of NRI according to the FEMA and according to the income tax. But what types of accounts offered to the NRIs? So there are different types of accounts. Like first one is NRE account, that is non-resident external account, which uh, can be managed in the Indian rupees, that is repatriable, and in this basically tax free interest is there, no tax is chargeable. NRO account is also in the Indian rupees, which is basically used to manage the income which is earned in the India. Then there is FCNRB account, foreign currency account, which handles in the foreign currencies. Like name is foreign currency account, so the currency is also the foreign currency, and also no exchange rate risk is there, like fluctuations problem or any other thing type of risk is available in that account. Then special non-resident rupee account, which is handled in Indian rupee for some specific transaction, for some specific business. So if anybody wants to open any of these accounts, so they NRI have to submit their prescribed application form, a proper application form. Obviously banks, they need the application for everything. Currently I visit bank for the ATM purpose, and my ATM is, I don't know where my ATM is. So I just applied the ATM just for withdrawing some money if I need in any case. So uh, for that they need the application in a proper manner, and when I give them the application, they don't see the application. They say, okay, your ATM will be there, come after some days, you will get your ATM. So first time I didn't face any type of server issue there. So and I have to fill this, give their application form, and then they have to give the undertaking to the bank. They have to inform the bank. Then when they are coming back to India permanently, they have to provide the documents like passport, visa, and employment proof that they are seriously the NRI. They have to prove that thing. Now, let's talk about the first account, NRE account. The questions are from this account, and also the case studies are also there. So, NRI rupee account means the account which is used by the NRI to park their foreign earnings in the India, but in Indian rupees. Suppose an NRI who is earning in USA, and that person wants to submit their money in India, so that person can open the NRI account in India, NRE account in the India, and can park their foreign currencies in the NRE account but in INR. So how that money can be added? If there is any remittances from abroad, like via the wire transfer, via the check, via any other sources, they can transfer from other NRE or SCNRB account. Like transfer facility is also available. Whatever the interest earned, they are earned on that account, they will park that money also. Any current income from rent, dividend, pension, if the tax is paid on it, they can deposit that money also. Where the money can be used for the local payments, if local payments are there in India for any organization, any company, or any shop owner, they can send money outside the India. They can send, they want to send money in Dubai, they can send. They can transfer other NRE or FCNR account, and they can also do the investment in the India, but only on the approved things, not the prohibited ones. Now the joint accounts and some operation rules. NRI can hold the account on the joint basis. So though two or more NRI can handle this account jointly, or the person of Indian origin. NRI plus any resident relative can open or manage this account, can join this account with the NRI. Resident joint holder can also operate by using the power of attorney. If that NRI give the power attorney to other resident, so that person can also operate this account, but some limited rights is there. They cannot open any other NRE account. They cannot gift to the resident, like, oh, that much money is that amount, so if I am the joint owner, so I can gift to the other person. That is not allowed. That person is not send the money to abroad. That person can make the local payment or send the money to the NRI account holder. So some other features, that account can be in the saving form, current form, recurring form, or term deposit. That interest earned is tax free in India. No tax is deductible on the interest earned. Also full repatriation, they can send the money back abroad, that is allowed. Nomination is allowed. Person, that NRI can nominate a person, even a resident is there or a non-resident. Temporary overdraft is available only up to 50,000, but that overdraft must be cleared in only 2 weeks. 2 weeks time is there. And one, that person returned to India, so that account will convert it to the RFSC account. RFC account means when the person NRI come back to the India, come back into the India on the permanent basis, so that account is converted to the resident account or the RFC account. Then what is exchange rate risk? Many times we listen this thing, exchange rate risk, exchange rate risk. So what is exchange rate risk? Available in that type of account if the account is in Indian rupees, but the money is coming in the foreign currency. So exchange rate risk is there, which is borne by the NRI. NRI is responsible for that exchange rate risk. But why? Because if the rupee weakens, so obviously the value of money in foreign currency terms might fall in that case. So that type of risk is generated by the NRI itself. NRO account. Okay, NRE account, I hope that understandable. Now the condition of NRO account. NRO account is also a bank account in the Indian rupees which can be used or which can be opened by the NRI by the foreign tourist who visited India for a short period. You can see there are so many YouTubers who came to the India and show the reality of the India, of the street vendors, of the some makes the videos in the positive way, some makes the videos in the negative way. So obviously this account help those foreign tourists also. They can help, this account helps the NRI, so they can manage their income, whatever the income they are earning in the India, whatever their income is from rent, from dividend, or from any insurance payment. So I hope that it is clear that what is the NRO account. Now let's move to the next account. So some more information about the NRO account, how to open this NRO account. New accounts are opened by sending money from abroad or by transferring money from any other account, whatever the account is, NRO, NRE or FCNR account. If someone is living in India, that person becomes the NRI. Their regular Indian account is changed to NRO account once they inform the bank. Suppose if someone is living in the India and having their account with any bank, suppose with the SBI bank, if that person is moved to the USA or any other part of the world, so that person have to inform to the SBI that I am going to become an NRI, so please convert my NRO account, NRI, like my regular account, to the NRO account. So when converting, the account holder have to declare that they will notify the bank when they are coming back to India, and they would not any giving any foreign currency to the resident for just exchanging in the exchanging for rupees, and all the money whatever they are crediting to their account is from the legal purposes, comes from the legal sources. So how many types of NRO account? Saving account, current account, recurring deposit, term deposit. And the interest rates and terms are similar to the regular Indian accounts. Who can hold these accounts? NRI can hold individually or jointly. PIOs can also open these accounts. Foreign nationals who are coming into the India for a short visit, they can also the NRO account. So what type of money can be deposited or in the NRO account? Whatever the money which is sent from abroad, illegal income also, transfer from any other NRO account, rupee gift or loans from resident relative, but there are some government limits and regulations that things according to these regulations. What type of money can be debited from an NRO account? If the payment are there for the local expenses in India, transfers to the other NRO account, remittance of the current income abroad, repatriation of up to US dollar 1 million per financial year. It is according to the RBI rules, and there are some transfer to the NRE account up to US dollar 1 million per year with the tax clearance. So some other important features: if a resident become an NRI, their resident account converted to the NRO account. Okay, if someone becomes NRI, so their usual account becomes NRO account, no problem in that. When NRI return to India, so their NRO account will be converted again to the resident account. NRO account allows the nomination facility. There is also the nomination facility available, means you can nominate someone to receive your accounts. Then a resident can operate the NRO account on the behalf of NRI, but power of attorney is needed, and this is only for the local payment. Foreign tourist can also open the NRO account for their short visit, and they can also withdraw the balance in the foreign currency if the account is just held up at least for 6 months. But people from Pakistan or Bangladesh, they need the approval from the RBI, because RBI must know that some Pakistanis or Bangladesh need this type of account. But there are some conditions for the Bangladeshis persons. If a foreign national leaves India after doing some work from there, so they can convert their resident account to the NRO account to receive any pending payment, which can be repatriated abroad after paying tax. Like that income will be sent it to the abroad, but after deduction of the eligible taxes. That FCNRB account, non-resident or person of Indian origin can open this FCNR account, but with authorized banks in India. What kind of account is FCNR? If it is a term deposit account, meaning you deposit money for a fixed period. FCNR account, these also opened by the NRIs and PIOs, but some only the authorized banks who are available in the India. Term deposit account means you are at least depositing the money for a fixed period, and minimum period is 1 year and maximum is only 5 years. Money is deposited, repaid in the foreign currency, so there is no risk of losing money due to the exchange rate changes. So that thing is available here, where you can here the get the money in the foreign currency, so there is no problem in exchange risk. Obviously, is joint account can be opened in that case? Yes, same condition like in the NRE and NRE or NRO account. Two or more NRIs can open this account. An NRE and PIO account can open a joint account with a resident relative. Okay, what are the credit and debits allowed here? Since term deposit is there, so the deposit time is fixed, so you can only add the money. Withdrawal or closure happens on the maturity, or withdrawals or closure possible if you want to close the account early. No exchange risk is there. You can send the money back with the interest. Interest is paid basically twice a year and is calculated on the 360-day year basis. Interest income is exempted from income tax in India, and nomination is allowed. Forward contracts can be booked here. RFSC account, for those NRIs who are now came back permanently to the India. When a NRI return back to the India, they can convert their NRE account to the RFSC account. Saving and fixed deposits are available here. Joint facilities available here. It allows the credit, which includes pension or some income maturity proceeds with whatever in the foreign currency. Interest earned in this account is completely tax free. Full repatriation of funds is allowed here without any limit if the person becomes NRI again, and after 2 years of returning, that NRI is treated as resident but not ordinary resident, so interest income still in that case remains tax free. SNRR account, this account for those NRIs or for those foreign residents who have business interest in the India. Those NRIs or those foreign residents who having the business interest, who want to do the business in the India, and they want to conduct some business transaction but in rupees, only, but in Indian currency. So obviously it carries the business name and does not earn any interest. Only business related deposit and withdrawals are allowed. That does not mean local type of transactions are allowed or any personal use of transactions are allowed. This account can held only for 7 years. No foreign exchange can be given to any resident who is living in India. Any resident, uh, no foreign exchange can be given. That does not mean if any person is there who wants to give or gift foreign currency to the Indian person, that is not allowed. So in this account, money can be repatriated abroad, money can be sent abroad, cannot transfer money from any other account. Like NRO account transfer is not available here. It is available for taxes. If the person become resident, then that account change to the resident rupee account. In this, opening account is there for the nationals. For the Pakistans and Bangladesh, it is available, but RBI approval. RBI said without my permission that thing is not available for the Bangladeshis and Pakistan. So loans and advances to the NRI. What are the loans facilities available to the NRIs? Bank can give loan to the NRI or also to the third parties against the security of NRI deposits. So this bank can give loan to the NRI or any other third party. Loan can be used only for the purposes that is allowed by the RBI. That does not mean they are starting their real estate business or they are starting their agriculture land and doing the agriculture related activities. Loan repayment is also there, which is done from the NRO account. Loans cannot be used for relending. Like that does not mean if any person get any NRI get the loan and that loan money is again lended by that NRI, that thing is not available. Any speculation is not available. Housing loan is also there. NRI can get the money for housing loan. They can buy the property in India, and the terms are similar. Whatever the terms are available for the residents in India, the terms are same for the NRI. No partiality in that. Loan is secured by the mortgage on the property, like collateral is there. And repayment can be done by foreign remittance, no problem is that, or from the amount available in NRE, FCNR or NRO account. What are the prohibited transactions for the NRI? Like NRI can't do these thing in India. They can't buy the agriculture land. They can't do any type of opening of farmhouses. They can't engage in any type of real estate business. They can't trade in TDRs, trade transferable development rights. Now what is the meaning of this TDRs? Basically this means the acquiring or developing any land in India. So that is basically the TDR, where the landowners with the restricted land, they can use to sell that land. That is not allowed in that case in the TDRs. And also in this, basically they contribute to they can't do any contribution to any government savings scheme. They can't involve in any type of activities which are related to the government savings. They can do the intraday trading or short selling in the securities. They can't do these things also. Okay, so okay, so that thing is clear. What is NRO, NRE and SNRR accounts? There are different accounts. Whatever I explained you, I hope that it is clear to you. If any problem is there, kindly ask in that chat box, or you can give the thumbs up if you like the class. Okay. Now let's start with the letter of credit. So what do you mean by letter of credit? Letter of credit is like a middleman. I'm just giving you the example between the importer or the exporter. They say that LC is saying that do your business, don't worry about the payment and don't worry about the goods. So it is a type of document where a bank that guarantees payment to a seller. Like suppose there is a person in India who wants to trade in USA with a person of USA. Now, th- that person is interested in selling their goods in the USA's person, but USA's person is not showing their trust. There is a trust issue. That person is saying, okay, send me the goods, I will give you the payment after receiving the goods. But that person is saying from India, how can I send you the goods? How can I trust you? If I send you I goods to you and you are not paying the goods, then what happen? So for this type of conflict between the exporter and importer, buyer and seller, LC is there. LC saying that I will guarantee the payment to the seller if the seller provide all the documents. This type of concept used in basically international trade, just to giving the payment assurance to the seller and shipping assurance to the buyer. It is act as a link between importer and exporter, which is handled by their respective banks, so the trust will become more, like trust is there between both of them. So what do you mean by the UCP rules? See, in the letter of credit there are so many rules. UCP, UCPDC, Incoterms, URR 755, ISB. So there are so many rules. Just go through with these rules one by one. Okay. So that documentary letter of credit basically is defined as a signed or an authenticated instrument which is issued by the buyer's banker, and they basically assuring that they will seller will get a payment. Okay. So UCP rules are there if anything is happening between the buyer and seller. So obviously rules and regulations are required, and these regulations are same for the worldwide LCs. That does not mean these rules are implemented in India, not implemented in the USA or in Germany or any other part. That rules are uniform for everyone. It is created by the International Chamber of Commerce, which is in Paris and established in 1990. These rules are known as UCP, Uniform Custom and Practice for Documentary Credit. The current version is UCP 600 after 6 revisions. Next revision will be 700 obviously, whenever the revision will come. And it is effective from the 1st of July 2007. So 4 main things from this slide. UCP rules established by ICC. ICC is in Paris, established in 1999. These are called as UCP, Uniform Customs and Practice for Documentary Credits, and effective from 1st of July 2007. But this is the current version that is called UCP 600. Now let's see the history of UCP. first evaluated in 1933. That is the infancy version of UCP 82, first version. Bank have to check the documents because checking of documents is very mandatory here. Owner, beginning, middle, end of the month is there. If anything falls on holiday, obviously date extends to the next working day. No banking responsibility for any problematic document. That does not mean that this is the responsibility of the bank. Then UCP 151 1951, applicant used instead of principal. They introduced the way of payment, acceptance, negotiation and purchase. And bank deal here also with the document. They are not dealing with the goods. They don't think about the goods. They just want the documents must be in the clear form. Description on the invoice must match the credit. So whatever the description is there in the invoice, that thing is matched with the credit. Then UCP 222 1962. So you can just make a rhythm 222 1962, which is adopted by the UK and Commonwealth banks. Credit is independent from the sales contract. Okay, that credit is independent from the sales contract. Then here confirming bank can negotiate the things. Rules here: beneficiary don't replace the document, don't play with the documents. In every revision you can see the importance of documents. Then UCP 290 that comes in 1974, that terms introduce the nomination here. Also there are rules for the combined transport and assignment of proceeds, that gave a default time of 21 days to just present the transport document. Now you can see that 21 days becomes how that days are less with every revision. 400 1983, there is a full restructuring of the UCP format. New concepts are there: deferred payment undertaking. Article is there for the original document. Article is there for the bank to bank reimbursement. And they also say that about the transshipment. Transshipment means when the things related to the shipment. 500, very popular, and credit is irrevocable in that case. Bank have only 7 days to check all the documents. They ignore any non-documentary condition. They clear the rules on who can sign the transport document. Then 600, that is the current version, which is aligned with the ISP 98. There are new articles for the definition and interpretation. They removed all the mention of the revocable credit. Revocable credit, see, this is the important because this is the current version. It is aligned with the ISP 98, and ISP 98 containing all the rules regarding the LC. Definitions are there. We will see all the definition. Revocable credit means, for what happens in the past, that revocable credit means if everything is done, everything is okay. Okay, so now in the case of irrevocable, seller change the things, change the agreement. That thing happened without the consent of the other parties, and also without in not in the knowledge of other parties also. So that thing creates the trust issues and also the problem of conflict. So that's why LC takes a decision that we don't want any type of revocable credit. Nobody can't change the agreement once it is decided without consent of any other parties, which whatever the parties are involved. There are rule for handling the lost documents in the transit. If the documents are lost, then there are rules for those lost documents, because obviously documents are important. Now you can see that 7 days become 5 days in that. Only bank have 5 days to check the documents. If the credit is silent, then the document have to fulfill their purpose. Like everything should be mentioned in the documents. There are new ways to deal with any type of disparate document, like any type of documents which are problematic, so there are rules for them also. Okay. So what is LC? Suppose if you are importing something from the from the another country, like machine, car, luxurious car, or ton of goods, so you don't want to send the money. Obviously you don't want to send the money because you want that first you receive the goods, and seller does not want to ship the goods and hoping that you will pay the first. So there is a letter of credit who is saying don't worry about the goods and about the payment, I am there, I have made a promise just to pay the seller exporter once the seller will submit the documents, and providing the goods are shipped as the per the agreement. It is a trust bridge which is between the buyer and seller. Now the thing is, who are involved in this LC? So many parties are involved here. Buyer, obviously, that is the importer, which request the LC from their bank. Seller, who is the beneficiary, who will receive the money obviously if the conditions are met. There is a issuing bank of the buyer which issues the LC. Advising bank is related to the seller, which checks the LC and informs the seller that everything is okay, you can place the order. Confirming bank, which is optional, which adds its own promise, like I am also there, I am also giving the promise to pay for more safety. That option is there. Negotiating bank, that pays the seller after confirming that, after checking all documents are correct. Then there is a reimbursing bank which pays the negotiating bank, confirming the bank back. Basically reimbursing bank is also helps in paying the payment to the negotiating bank. Now there are types of LC. Revocable LC, which is used in past, now it is not used. Basically it is banned, but we can say it is not secure and rarely used. It can be cancelled by the buyer bank without telling the seller, and conditions are changed in that without the consent of the other party. Revocable LC can't be cancelled. If the all parties are saying that okay, you can cancel, then it is okay, but it can't be cancelled. And one of the safest LC, if not mentioned, it is considered irrevocable by default under the UCP 600. It is mentioned, if irrevocable LC is there, if anything is not mentioned in the LC, whether the LC is irrevocable or revocable, not mentioned anything, that means UCP 600 considered that LC as a revocable LC. Now irrevocable LC confirmed. Now another bank, irrevocable confirmed LC means that is another bank, like the seller's bank confirms the LC and promises to pay. And it is useful if the seller does not trust the buyer's country or bank. For example, revocable LC is that credit if the terms and condition of which can be cancelled by the issuing bank. Irrevocable LC is a letter of credit or an agreement between a buyer and a buyer's bank, that buyer agrees to pay the seller as soon as conditions are met. But it is revocable, so the term of the letter cannot be changed without the agreement of everyone involved. Irrevocable confirmed letter of credit, this is a irrevocable letter of credit that cannot be changed or cancelled unless everyone involved. Irrevocable letter of credit provides more security than revocable ones. Then next is transferable LC. What is transferable LC? This is a letter of credit where the beneficiary beneficiary requests to transferring bank to make the credit available in part or whole for more other beneficiaries. That is called the transferable LC. Then there is a red clause. Red clause is basically demanding advance from the buyer just to starting the manufacturing of goods, in which buyer is demanded with the advance. Okay, green clause is a letter of credit which contains to bank to make more advance. It is same like red clause. Then back to back LC is a letter of credit which is a negotiable instrument, in which sellers get a letter of credit from the buyer and seller further transfers the letter of credit to the supplier. Then there is standby LC. Standby LC is a legal document that guarantees the bank's commitment of payment to a seller in the event that the bank or the buyer client defaults to the agreement. Then there is a revolving LC, is a letter of credit which is a single letter of credit that covers the multiple transactions over a long period of time. It is very specific, that is used for regular shipment of the same commodity between the buyer and exporter, that is seller. So transferable LC, in which the transfer of LC is to the another beneficiary. Red clause LC, seller get the advance money to buy and make the goods. It is written in red at that time in olden days. But green clause LC, same as red LC, and goods are stored in the warehouse, and it offers the more security to the banks. Okay. Site LC means immediately paying. If the seller submits all the documents, that the site LC saying, okay, I will pay in the immediate basis. That is also called document against payment. Usance LC, that is acceptance LC, that payment is made after some time, after 30 days, 60 days, 90 days, and it is also called document against acceptance. Deferred payment LC, that is similar to the usance LC but no bill of exchange is there. Payment happens on a payment future date according to the agreement. So site LC, immediate payment. Usance LC, after some time. Deferred LC, in the future date according to the agreement. Negotiation LC, in this nominated banks check all the documents and then pays to the seller. It is freely negotiable. Or back to back LC, used by middleman exporter just to buy the goods using the original LC. One LC supports another like a domino effect. Is the things clear? I hope that things are clear. I know in English language we can't talk too much, like we can't include too much things. Things are very up to definitions and the concepts. So, and taking that long marathon, that morning session is typically difficult if we compare it to the evening session, because energy requires in the marathon sessions. So I hope that everything is clear. If anything is in doubtful category, so please comment in the chat so I can explain your doubts, because if you are watching this session, so obviously you will learn the thing from here. That is the basic aim of this marathon. That's why I put this marathon on a 1 week ago, so you will get the 1 week time to go through with the things. Okay. a standby LC that works like a guarantee, that gives the guarantee, used when someone fails to do something like pay or ship. That LC is saying I am providing the guarantee, and when someone become default, that LC comes there. In that, seller claim the payment by providing that buyer did not perform. So in that LC, standby LC is used. Revolving LC used for the regular deliveries, that is monthly or supply. This LC refilling for each installment of shipment. So basically revolving LC needs in that type of things which requires at the timely basis at a specified time. So what is the meaning of UCP 600? Let's learn about more things about the UCP 600. Uniform custom and practices for documentary credit, which are in which the rules are created by the ICC. UCP 600 current version, make sure everyone have to follow the same rules when dealing with the LCs worldwide. So you can see some memory tricks are there. Red means ready money, advance, give advance before shipping. Green means goods are there in the warehouse. Sight means you have see the docs, now pay. Usance means use some time. Back to back, one LC supports another. Standby is there in case of failure. Okay, just a minute. In the daytime there are so many works are going on with the things. Just a second. So letter of credit is a bank saying, don't worry seller, I will pay you if you prove you did right job. Letter of credit saying, don't worry, I will pay you if you are doing everything correct. Now let's learn about the journey of an export letter of credit, which is explained step by step. So journey of a export of letter. First one, what happens at the end of export letter of credit? Buyer first places the order. Buyer have to place the order for starting the thing. Who? Any overseas buyer who is in the USA. Okay. Buyer sends a purchase order to the Indian exporter. From USA there is an order for Indian exporter. The order has all the terms and conditions from manufacturing to shipping, all the things are included. Then exporter accepts the order. Suppose we can take two persons here for better understanding. There is a person who is in the USA. Suppose that person is Stefan. Okay. One person is there in the India who is exporter. Suppose Chinku. Okay. Now Chinku receives order from the Stefan. Okay. All the terms and conditions from manufacturing and shipping. Then exporter accepts the order. Who? Indian exporter. Indian exporter accepts the order, and exporter checks that Chinku checks everything, like everything is looking fine. Then it confirms the order and also requests an LC from the buyer. Okay. Then after that, buyer request LC from their bank. Buyer say, okay, buyer is requesting LC from their bank. Buyer bank is in USA. Buyer goes to their bank, shares the order copy, requests the LC in exporter's name. Then buyer's bank issues the LC via SWIFT. Buyer's bank issues the LC via SWIFT. You can see the SWIFT work here. Bank check that buyer credit worthiness and the approvals that buyer is able to pay the goods or not, goods amount or not. Then LC is sent electronically by using this SWIFT, that is MT700, to the exporter banks in India. Means Chinku banks receiving the LC by using the SWIFT code MT700. Then exporter bank advises the LC. Exporter bank, that is the advising bank, that verify the authenticity of the LC, then advises it with the exporter. Okay. After that, exporters check the LC. Who? Exporter reads the LC carefully, confirm it matches with the order, starts the manufacturing goods and prepares for the export. Okay. Goods ready. After exporter files the necessary documents, whatever the bill or EDF in the case of goods, export declaration form, and soft tax in the form of, in the case of software, custom check approves, data uploaded to the RBI EDPMS form by the EDI. So that means the process is completed now. Exporter submits the document to the bank, submits the original exports document like invoice and all the bills to the exporter bank. Exporter also sends the copies to the buyer for the preparation. Now bank do the scrutiny and document formatting, like exporters bank do all the check documents and are there with the LC terms or not, then documents sent to the buyer bank for the payment or acceptance. Now buyer bank review the thing. If there is a site LC, then the immediate payment will happen via SWIFT MT code 2202. If the case is of usance lift LC, then it sends the acceptance which is pays on the due date which is mentioned. Then buyer clears the goods. Who? Buyer clears the goods. After getting the documents, buyer goes to the custom, completes all the formalities and takes the delivery of goods. Then exporter bank get paid and receive the payment. That bank will credit the exporter's account and update the EDPMS that export is completed, export is done. Clear? Okay, so that is the only process here happened in the case of export. Now so you can see the summary here, what are the steps and what are the actions, who takes the actions. I will provide you the PDF. So now LC is a bridge of trust, SWIFT is there where secure messages are there, EDPMS where the RBI export tracking system is there. If the site is LC, money comes fast. If uses, wait till the due date. Now let's learn about the import LC, step by step journey. India imports from the USA. See, importer in India places an order. Who? Indian buyer. Indian importer places an order for goods with the US suppliers, mentioning all the terms and conditions. Then US exporter or supplier confirms the order, review the order. If everything is okay, it asks the Indian buyer to open an LC in their favor. They sends a copy to the confirmed order. Then who? Indian buyer approaches the bank. Who? Indian importers bank checks all the buyer track record and the credit worthiness. It is satisfied. It issues the LC via SWIFT to supplier bank in the USA. Then LC reaches supplier bank in the USA. Like US bank, advising bank, reaches the supplier bank in the USA, and then verifies all the authenticity of the LC, then advises it to the supplier. Then supplier in the USA review the LC, read the LC carefully. If it matches with the order, then it start manufacturing the goods. Supplier clears the goods with the US custom, hands over the goods to the courier and get the transport document. Supplier docs are submitted with their bank. They send the original documents and declaration according to the US law. Then supplier bank check all the documents and sends to the India. If documents match with the LC, either negotiate or forward them to the Indian bank, and also sends the copies of documents to the Indian importer for the preparation. Importer bank uh, uh, that is securitizes everything again, checks the everything in again manner. They check the all document, and then payment sent to the supplier via Swift MT code 2222 to the Nostro account. And then if the usage LC is there, the acceptance message that we accepted the goods, payment will be made on this date. Then supplier get the payment, releases the amount to the supplier, and then importer have to file the bill of entry with Indian custom verify all the documents, goods released, entry uploaded on the IDPMS by the bank, and final step, importer, that is authorized bank of the importer, submit all the docs, update the bank, and closes the entry in the IDPMS. So that is the process of importing and exporting. Clear? Process is not long, but yes, everything is played via LCs. So this is the quick summary table, and there are some memory tricks. LC, that is a trust between buyer and seller using the banks. Site LC is instant. Users LC is paying later. Swift, bank to bank securing messaging. Nostro account, our money in their bank. What is UCPDC? Uniform custom and practices for documentary credit. Set of international rules that basically giving the advices to the LC that be do all the things in that international trade, published by the ICC, that is first cleared in 1933. There are so many revisions come now. Current version is UCP 600. Why UCP 600 was needed? Trade are expanded, so rules need updation. 500 has 49 articles that are complex or outdated, but 600 has simplified language which reduced the articles to the 39. It is based on the feedback from 41 countries, which includes the India also. So there are some key features of UCP 600, which is very simple, short and smart. Let's learn about these articles in the class. Major changes are there in the UCP 600. That is not automatic, like not automatic. Everything must be there in the LC. Everything is must be in the LC. No thing is assumed in that case. All credits are irrevocable, cannot be changed, cannot be cancelled unless everyone agrees, whatever the bank, buyer or seller. Then there must be clear definitions. New definitions are added for issuing bank, nominated bank, or the confirming bank. There must be beneficiary, complying presentation or presenter, means new definitions are there for the beneficiary, nominated bank, issuing bank. Article 2 or 3 is saying that. And so you can see for whom new definitions are there. Bind PC, not blind PC, bind PC. Bind PC, beneficiary, issuing bank, nominated bank, document, presenter or confirmation. Then declare deferred LC, that is clarified in the article 7 and 8. It issues and confirm banks to pay even the nominated bank prepared earlier. Advising bank role is article 9, which ensures that same document is forwarded to the beneficiary, no tampering is required. Amendments are there, article 10, if seller accepts or uses the amended LC without replying, it is taken as accepted. Then bank 7 days reduced to 5 days only, and there is info in the document does not need to be word for word same, just should not conflict, means everything in the document does not mean everything is word to word, that thing create conflict. Address must be okay, there should be address mentioned, but no exact match is required. Bank have to follow only the follow documents. If something is not document related, they have to ignore this thing. Then desperate docs means banks have to hold the documents and wait. They have to return the document. They have to ask for applicants for the waiving, and pay only under reserve is allowed, that is saying the article 16. Okay, so these are the articles, and these basically is the summary type of, you can see 1 to 5 definitions are there, 6 to 10 availability expiry obligation is there, 11 to 17 nominated bank complying presentation is there, 18 is saying about the invoice, 19 and 27 is saying about the transport document, 28 is saying insurance document, 29 to 33 drawings and presentation rules are there, 34 to 37 there are disclaimers, 38 to 39 there are transfer and assignment. And one thing, in this marathon I don't ignore any topic, I just not left any topic, I include everything, because we don't know what IIBF actually want, so everything is mentioned. So just go through with the PDF, it will help you a lot. And I'm accepting numericals and case studies are not there, because there is a separate class for those numericals which I focus only on numericals part, so you can go through with the numericals. And in the upcoming week there is a classes for the MCQ, fresh MCQs not copied from anywhere, so you can practice these MCQs by attending the classes, and I will provide you the PDF also. So article 17 is saying anything with the real stamp, signature, typed content, or if it says original it counts. Transport document is saying article 19 to 27, no need for the name of the ship master. Charters can sign the document. Clean clause not required unless the credit asked for it. Insurance document also there, and partial shipment concept is also there, so in that case partial payments are also allowed. If the documents are lost in the transit, suppose if all documents lost, so nominated bank sent them, issuing bank have to still pay if the documents are lost. Force majeure means no grace period after the bank reopens. If the LC expires during disaster, that means no payment is there. Transferable credit means second beneficiary have to present doc to the transferring bank. So what are the key parties who are involved in the LC's transaction? Applicant, that is buyer or the importer. Applicant responsibility is that to provide everything in a clear way for issuing the LC. They should have to avoid any unnecessary details or reference to any other older LC, like everything must be clear. They have to protect the banks from issues that is caused by the foreign laws. Then issuing bank, that is a importer bank. That bank have to act on the behalf of the buyer. It ensures that buyer is trustworthy before issuing any LC, and also they are responsible if the payment at the site or at maturity. They ensure that LC is clear without any confusion. They check the documents with care. They inform within 5 banking days if documents are non-compliant. They communicate if there is any problem is there. So these are the responsibility of the issuing bank. They have to keep check on these things. Advising bank means they informs the seller or beneficiary about the LC. They have to verify the authenticity of the LC. If they are not advising this thing, they have to inform the issuing bank also. If they are unable to confirm the LC authenticity, they have to inform issuing bank and seller. See, advising bank is saying my work is just to inform the seller or beneficiary, and their work is also to check the authenticity, that LC is authentic, is valid or not. If that thing is not valid, they have to tell this thing to the issuing bank that I don't find the LC is okay. And if they are not able to confirm the authenticity of the LC, they have to inform the issuing bank as well as seller. So these are the responsibility of the advising bank. Then confirming bank is there. Okay, I am providing the guarantee, and if someone is refusing to confirm these things, they have to tell this thing to the issuing bank. They can forward the LC without any confirmation, but they have to inform all the parties. They don't need any confirmation, but they have to inform all the parties. Then there is a negotiating bank, which examines all the documents, that the documents are according to the rules or not. If there any problem is there, so they can't negotiate. They can negotiate only on those situations when the document match the LC terms. They have to follow all the rules, whatever the rules are provided by the UCP, or whatever the rules are there for the international standard banking practices. Okay, so UCP 600 have so many articles, so many responsibilities. Like applicant is there, they have to give the clear instructions. Issuing bank is acting on the behalf of the applicant, so it ensures that the issuer it ensures about the creditworthiness of the applicant. Advising bank has the option to choose whether it wishes to advise a LC or not. Confirming banks give a definite undertaking in addition to the issuing bank. Negotiating bank responsibility to examine the documents according to the rules of UCP. Reimbursing bank is also there, which see that everything is according to the URR 725. Then beneficiary, they check that every document is accurate according to the LC. They can't claim based on the buyer's bank contract. They can't say that I will depend on the buyer's bank, I will do the things according to the information that is provided to the buyer's bank. That thing is not considerable. So what are the protections how banks will protect themselves? Suppose if the buyer is unable to pay the goods, what happens for the banks in that case? If bank faces the losses, if is there any situation which makes the parties unavailable, like if buyers receive the goods or not paying the goods, so in that condition it's the bank's responsibility to pay the goods. So that becomes a fashion. Bank will pay the things, and everyone is buying the luxury cars and everyone is buying the things. So basically, how bank protect themselves? they are not responsible for the genuineness of document. They are not saying that provide us the genuine document. They are just saying if you are not providing the documents, we can't do anything. They are not responsible for any loss of document or messages. They are not responsible in doing the translation errors. They are not responsible for any natural disaster, for any civil unrest or any external disruptions. They are not responsible for mistake of the correspondent bank, because that is chosen by the bank or the buyer. They are not responsible for that. Buyer pays the third party charges if not recovered. They pays the third party charges, but buyer is responsible for the losses. See, buyer here pay the third party charges, and buyer is responsible for the losses under the foreign laws. So these are the protection of the banks. Banks will protect themselves. They will not face any type of loss just because of these export and import. They are not doing any type of facing any type of loss. They have to make sure that everything is the responsibility. They are just acting as a trust bridge. They are making a bridge of trust. They are not doing any other thing. Okay, now what is bill of exchange? Basically, if I talk about the bill of exchange, is one of the important financial document which is drawn by the beneficiary on the LC's issuing bank. It tells the issuing bank to make the payment immediately if it is drawn aside or accepted and pay on due date. It if it is drawn on acceptance basis, it should in normal due course satisfy some conditions are there drawn by the beneficiary or the issuing bank, and it indicate the issuing bank name and letter of credit. It should unless and otherwise specified drawn in the currency of whatever the currency mentioned in the LC, not exceed the amount of LC. Any corrections should be authenticated here. Okay, so we can say drawn by seller on the issuing bank, mentions the LC number and issuing bank, be in the LC currency, be corrected, authenticated if edited. What is invoice? Invoice, we know that is a type of bill where everything is according to the LC terms. It have include the applicant name, exact goods description, LC number, contract reference, sales terms, total value not more than LC, shipping info is there like weight, packing, etc. should be there. So basically that thing match the LC terms invoice, which contains all the information according to the LC, and applicant name is must be there, and goods descriptions should be exact. Okay, now there is a concept of bill of lading. What is the meaning of bill of lading? See, bill of lading, firstly it is related to the transport document, which is a type of a evidence that goods are moved from the port to the port of destination. It is a type of receipt which is issued by the ship owner or some agent which is a authorized agent, and bill of lading is a suppose as a set of complete negotiable copies with a number of non-negotiable copies, and ship owner signature should be there or authorized agent signature should be there. In this bill of lading, the letter of credit should be there, and the letter of credit should call the shipped on board bill of lading, and basically this bill of lading should not be closed unless specifically permitted under the LC. So we can say the proof that the goods are shipped must be complete with original and non-negotiables, that is signed by the ship owner agent, dated on or after LC issuance clearly show the freight weight LC number unclosed and the shipped are there on the board. So what are the foreign currency liability and the crystallization? So what is crystallization? When the bank converts foreign currency into the INR. When the bank converts the foreign currency into the INR money. When it happens, in the case of sight bills, in the case of usance bill, it uses the bill selling rate or agreed forward rate. So LC, now I am sure you know that what is LC and why bank need safeguards. Obviously they include the foreign money, they include the foreign goods, and also the loss, huge amount is there, and fraud of risk is obviously available there. So what are the bank checklist before sanctioning LELs, any LC? So first of all, only deal with the genuine well-known customers. Okay, all the KYC norms should be followed, and it verifies the importer's trade experience. Be careful about the 100% cash margin, and credit report should be there. Ensure their staff knows about the forex laws and rules. Document must match trade and control policy. They have to take approval if transaction is beyond the limits, and every check on evidence of import is should be there. So that is the bank checklist before sanctioning the LC. Okay. What are the common risks that is involved in the LC transaction? Obviously, the situation of mismatch of the documents. There is a disputes over the quality of the goods. Legal issues are there, and maybe any type of problem. Legal issues are there, and country specific currency restrictions are there. Buyer not retiring the bill on time. There are some import of restricted items and no proper license is there. So what importers and exporters have to do? Buyer have to check the rating of the seller, as we usually do in the e-commerce website. We check, if we order anything, we check the things, we check the reviews. That is the thing. We know that the trade control rules for both the currency, if there are any restrictions available, if there is any problem between the two countries are available, like if we want to export, we want to import anything from the Pakistan, so obviously that thing is not that much easy. Okay, so uh, documents must be like that, they meet all the needs. They have to book a forward contract to manage the currency needs. Then exporter seller, basically what that exporter seller should send documents as per the LC terms. They have to dispatch the current goods. They have to be aware of the legal system in the buyer's currency. Then ISP 98 rules for the standby LC. ISP rules are there for the standby LC. So what is the meaning of this standby LC? See, in the international trade, there are so many LC transactions, where is the seller is assured that by submitting the documents with according to the rules, with according to the terms and conditions, they will get the payment. So standby of LC is used in that situation when there is a problem of non-performance, and it is a substitute of guarantee. Usage of standby LC is mostly used in USA, where guarantees are not used. These standby LC act as a standby for a guarantee. So this type of LC is opened by the banks in those countries where there is a restrictions on issuing the guarantee, and therefore standby LC provide there a suitable substitute for the performance or the financial guarantees. Okay, so we can say with the help of this international standby practices, a set of rules are there, which is obviously made by ICC, and in this basically authorized dealers have to issue the standby LC either under ISP 98 or UCPDC 600, which is according to the mutually consent of the both parties. So banks establish this standby LC for the transactions, for the different types of transactions. So that is the thing is saying in that ISP is there for the standby LC. They have to follow the rules of India. They have to define the days of banking. They have to notify if this anything is dishonoring the LC, if they have to allows the LC to be used in the loan syndicates. Then URR 725, that is a also a important thing. URR 725, what is this URR 725? See, there is a reimbursement of the value of documents that is negotiated. So ICC is there. ICC has banks while issuing the LC, they says that they authorize the negotiating bank to claim which is bought out the uniform rules for bank to bank reimbursement. The responsibilities of the bank, claiming bank, reimbursing bank, and all other related parties are incorporated into the letter of credit which have been specified in the rules. See, some provisions and definitions are also there under the URR. In this, if a bank A is saying to bank B, just pay the bank C, that is the issuing bank, that is the reimbursing bank, and that is the claiming bank. So issuing bank have to open a LC, reimbursing bank pays on the behalf of the issuing bank, claiming bank negotiates the document and ask for the payment. Bank have to ensure that reimbursement authorization include LC number, amount, bank name. They authenticated means will be used here like SWIFT. No expiry date is there. Claim should be settled in the 3 working days. So LC are safe, but strict checking is required. And the standby LC is a backup tool used where guarantees are restricted. Rules are there which guide the banks globally. Bank and clients have to follow the due diligence and the trade laws here. Okay. So, what is the meaning of this ISBP 745 International Standard Banking Practices? So this is basically again a ICC publication. Okay, this is again a ICC publication, and this basically provides guidance, important guidance regarding the examination of documents which is presented against LCs. And it is very important to note that ISBP cannot in any way change the UCP 600 rules, which is already applied to the letter of credit, and this is initially approved by the ICC, and the first version act as a comparison guide to the UCP 500. But current rules that are the current rules at that time. So when our rules revised to the UCP 600, so the ISBP was updated by ICC publication number 681. Then there is a new update with the newly update UCP, because the current update is UCP 600. Then a fully revised version of ISBP ICC publication 725 was published in the July 2013, and this basically includes both new and rewarded interpretation, as well as become very essential publication for everyone which is involved in the letter of credit. So basically, what are the objective of the ISBP? Just to follow the uniform rules for everyone, just to provide practices that should be applied by the documentary credit practitioners, which helps to reduce the any type of problematic presentations. So that is basically this saying, that is the International Standard Banking Practices. It is a guidebook which is made by the ICC, and banks helps checking the documents which is submitted under the LC. ISBP is not a law but helps in interpreting the 600 rules. It is first published in 2002, updated with UCP 600 in 2007, and then revised again in 2013. It reduces the confusion and minimizes the rejection of documents. Its main goal is to promote the uniformity, help the banks and traders in avoiding any type of mistakes or any type of problems. So it makes the things easy for importers, exporters and the banks. It ensures that documents are accepted smoothly everywhere without any loss or delay. Then Incoterms 2020, international commercial terms. So so many parties which are in the contract where they are not aware about the trade practices about their in their countries, which obviously cause the misunderstanding and results in unnecessary disputes are there. Now Incoterms published by ICC, which is a set of international rules for telling about the trade terms. This ICC publication updated many times, but latest version is Incoterms, International Commercial Terms 2020. Basically, there are four categories are there: departure, main carriage paid, main carriage unpaid, and the arrival part. So you can see these are the rules published by ICC, who is responsible for shipping, insurance, duties, risk in the international trade. They help the sellers and the buyers which avoid the misunderstanding. These Incoterms apply only to the sale of goods, not the transport contract. Latest version is Incoterms 2020. Departure terms: buyer takes all the responsibility from the seller's place. Now from the seller's place it becomes the buyer's responsibility. Buyers pick up the goods from the seller's factory, that is the X work. And main carriage paid means sellers here main carriage paid, that means seller pays for major transport. CFR, cost and freight, seller pays freight but handles insurance. CIF, cost, insurance, freight, seller pays for freight and insurance. CPT, carriage paid to, seller pays until a certain place. CIP, carriage and insurance paid to, which is same as CPT, but insurance is added here. Main carriage unpaid, buyer takes more responsibility. Free courier, like sellers delivers to the courier, to the transport company. FAS is telling about good placed next to the ship. FOB, free on board, goods loaded onto the ship by the seller. Then arrival terms are there. Seller deliver goods which are close at the buyer's location, that is DAT, delivered at terminal, goods delivered at the terminal. DPU, delivered at places like goods delivered and unloaded. DDP, delivered duty paid, where seller pays all the cost which also include the custom, and the examples are also given with them. Now, so why this Incoterm matters? Obviously, in avoiding confusion in the contracts, it clearly decide who pays for what. Smooth flow is there, used in the international trades and invoices. So this is the chart of Incoterms 2020, which defines the clearly the obligation of seller, transfer of risk, and the buyer obligation. You can see here in the case of X works where the transfer of risk happened to the buyer. Then free courier, where there is the transfer of risk at the you can see here in the case of first courier. Then buyer responsibility. Free along ship, alongside ship, here this is alongside ship, and then buyer responsibility starts. Free on board, here the loading port, where the port of loading, that means buyer obligation start. In the case of everyone, you can see where is the risk transferred and from where the buyer's obligation started. So that is the chart which clearly defines the things. So just go through with this chart and give me only 1 minute. In the India, who manages the Indian foreign trade? Obviously, this is the question which says about that in India, who manages the Indian foreign trade? In India, DGFT is there, who sets the policies, who sets the procedures for import and export. DGFT, Directorate General of Foreign Trade. RBI is there, who manages all the foreign exchange payment regulations and everything related to the foreign exchange. Okay, then So RBI is able to manage all the foreign exchange for payment regulations and the export financing via FEMA. Then there is a FEDI, that is a self-regulatory body that promotes all the best practices in the foreign exchange market. So just think about the DGFT, which is a trade policy maker, and the RBI as the money manager of the foreign trade. Important laws and guidelines here. FEMA 1999 is say governs all the foreign exchange transactions, and RBI enforces this. Then FTP policy, which is issued by the DGFT to guide the trade procedures and the regulations. Then UCP 600, URC 522, URDG 500, 758. Incoterms, they are the global standards which are by the ICC just for making the trade documentation, trade collection, trade guarantees standard. Export financing means when the RBI is there, that exporters get their loans at very low interest rate, so they can easily compete in the international market, and they can also do their export business easily. There are so many credits are available, like packing credit, post shipment credit, export bill discounting. There are also some important guidelines which are available, like imports are regulated to protect India's foreign exchange reserves. It encouraged advanced technology and fair competition. DGFT, RBI, they are working together to control that what thing can be imported. Then there is a IEC, that is a 10-digit code. That is a 10-digit code that is there for every EXIM business. Why it is needed? Because this is a unique code for any import or export activity. Where to use this? On the invoices, shipping documents, and the custom forms. What are the additional registrations? Exporter of services who need the this RCMC and SEPC, means there are two types of forms, we know that. Export declaration form. Export declaration form is required when the exports are related to other than software. Softex forms is there with the electronic data interchange system. At the certain offices there is a system which is used, electronic data interchange, where shipping bills are processed electronically. So Softex form is required when the things are related to the export software, right? So export declaration form, EDF and Softex export have to declare that they realize the full value of the goods in the foreign exchange within the prescribed time. Now, who is exempted from filing the export declaration forms? See, if there are gift which is less than 5 lakhs, so this is a small value, non-commercial, so that does not mean that they have to fill the EDF. If they are testing the repair goods, so that does not, they are not eligible. If the personal items of the travelers, that is the non-commercial item. Ship stores military items, so that is a government military related items. If there is a defective import for the replacement, so that is non-commercial, permitted zones are there. If there are software parks that re-export, so these are basically production for these are the basic aim is for the production and the testing. Then aircraft parts for the overhaul, that must be re-imported in the 6 months. Free samples and publicity items are there, so they are not promotional, so they are not able to eligible for selling. So some exemptions need certification as well as approvals from the DGFT as well as from the authorized dealers. So what is the workflow of EDF? They have to prepare the shipping bill, with the EDF form. Then they have to submit that form to the custom will check the things, then custom will return the exchange control copy, exporter submits it to the authorized dealer bank, then foreign exchange is tracked and then verified under the FEMA. Now what are the time limits for the export procedures? Submission is there for the export docs, export documents needed, EDF is needed, but within 21 days from the export date or Softex certification. If regions are not things are not done in 21 days and the regions are unique and not in the controllable situation, then authorized dealer still can accept them later, but region should be genuine. Then realization of export proceeds, like bringing the money into the India, that must be happen in the 9 months from the export date. Warehouse, which is and the abroad up to the 15 months, which is approved by the RBI. There are some COVID relaxation for export up to 31st of July 2020, and 15 months are allowed here. Some type of special economic zone, STP, BTP, these are the units are available, but for the 9 months, but extensions available here. So what are the method of receiving the goods? What are the methods are there for receiving the goods? Okay. Okay, I will upload the PDF of this class and also all the previous class. After the when the class is over, I will upload. Okay. So what are the methods of receiving the payments? You can get the export payments through the bank draft, credit to Nostro account, and also by the inward remittance if someone wants to send some money in the India. Foreign currency notes are also acceptable. Payment from the FCNR NRE account, acceptable. International credit cards, okay, acceptable. INR payment are there from Nepal and Bhutan, acceptable. Gold, silver, platinum, gems are also acceptable. So all the payment must be in the eyes of authorized dealer. Especially payments are authorized by the authorized dealers, but in except some cases require the higher authorities. So authorized dealers are permanent, they have to check all the payments. ACU means that comes in special country mechanism. ACU countries like Bangladesh, Bhutan, Myanmar, Sri Lanka, Maldives, Nepal, Pakistan, India, these are the countries who uses this ACU dollar, ACU euro, ACU yen for the settlement. Nepal, ACU member, that is exempted from the ACU system. Iran, freely convertible currency is available according to the RBI. Export benefits and adjustments. Agency commission that is allowed the EDF Softex form, and reasons are justified here, and up to 25% reduction is allowed. Importer having at least 3 years a good track record. Then EDPMS. What is the meaning of EDPMS? See, it is launched by the RBI on 1st of March 2024. EDPMS is like is just like a diary which records all the transaction related to export. It goes simplifying filling of the export returns, monitors the shipping bills and delays, catch the exporters who delay in the realizing payment. Banks have to send the export data to their branches. Then branches follow up with the exporters. Then RBI, they update a caution list. Whatever who are the risky exporters, this document included. Bank have to record the advance payment for the exports in the EDPMS. XOS is discontinued now because EDPMS is there. IDPMS is the brother of EDPMS. This is for the importers. and it also tracks the evidence of the import, ensures the timely payment should be there, prevents the shady or fake reports, like no duplicate or problematic type of import should be there. Time limit 6 months from the shipment, but in the COVID-19 there is 12 months, now it's again back to the 6 months. AD give 3 months relaxation if the reasons are justified. Factoring, sell now, collect later. That is the concept of factoring. Like sell now, pay later. That is like a credit card. In the credit card we have the system of factoring. It is a continuing agreement between a financial institution, that financial institution is also known as factor, and the business concern, that is exporter or seller. They are selling the goods or services to just track the customers on the open account basis, where the financial institution or the factor purchases the client book debts either with or without with the permission of client, and control the credit which is extended to customers, and everything administrators in the sales ledger. So there are so many services are providable in the factoring, that is debt and administrator, credit protection, factor financing, or here immediate financing is there up to 75 to 80%. There is no requirement for the LC. They checks the credit check, they do the credit check on the importer and buyer, they follow the advisory services for the new areas. So imagine, suppose if you are selling goods but you don't want to pay it for the buyer payment, so here factor is entered. You sell your invoices, unpaid invoices to a factor, you get 70 to 85% upfront. Factor collects the money from your buyer, then credit checks on the buyer, sales ledger management is there, credit protection is there if the buyer defaults, single factor is there, two factor is the type, and direct import financing is also there. Then forfeiting, in which export now get 100% money, forget about the risk. Forfeiting basically is, we can say, another product for the financing of export receivable is forfeiting. It can be defined as a mechanism for financing by uh, discounting of export receivable without recourse to the export or seller for a medium term on a fixed rate basis or the full value of the contract. In other words, we can say forfeiting is a purchase by the financer of the medium term export which claims on the buyers without any type of recourse to the exporters. It is a type of source of finance, not a type of credit insurance, and no other costs are there other than financing costs are involved in the transaction. So basically here, for medium term exports like machinery and projecting, forfeiting gives full cash in advance without any recourse. So exporter gets the buyer acceptance of payment via bill and notes. A financer buys the bills at a discount. No worry if the buyer defaults, risk is passed to the forfeiter. So 100% cash is there, no need for credit insurance, peace of mind from political and commercial risk is there. What are the exchange and trade control guidelines for the importers? Here IEC code, check the legality of the goods, payment methods should be proper, deadline within the 6 months of shipment, advance payment should be there. What are the evidence for the import? Submit the bill of entry, if not bank will chase for 3 months. Big companies can submit the CEO or auditor report certificate. Now what is the meaning of ECB, external commercial borrowings? That is basically type of a loan. ECB is a type of a loan. See, ECB is a type of a loan in which it is taken by the Indian companies from the foreign sources in the foreign currency or in the Indian rupees. They are basically medium to long term borrowing, usually 3 to more years. So, who can borrow? Companies who are allowed to receive the foreign direct investment, some startups which are get recognition from the central bank, some port trust units are there, CIDB, Exim Bank, and some microfinance entities. What ECB cannot be used for? Same real estate activities, some stock market investment, some equity investment, working capital, general business expenses, paying back rupee loans, lending to the others for any of the above activity. Who can lend? Who are the recognized lenders under the ECB? See, lender should be a resident of Financial Action Task Force compliant country for or from IOSCO, that is International Organization of Securities Commission compliant country, that is basically multilateral and regional financial institution, where is the India is a member country, and individual as lenders they can only be permitted, and then foreign branches subsidiaries of Indian banks they are permitted. Foreign branches subsidiaries of Indian banks which are subjected to some norms which can participate as arrangers, underwriters, market makers, they are also allowed. So now maturity rules: minimum average maturity period, that period is of 3 years. For manufacturing companies there is only 1 year, which is having the US dollar of 50 million a year. From foreign equity holder, and that is used for working capital general purposes, the time is 5 years only. For the general purposes there is only 10 years period. Loan repayment is of 7 years, loan repayment is of 10 years here. Then all in ceiling cost, max interest plus charges, like new ECB's benchmark rate plus 500 basis point value, that is the all in ceiling cost. Basically for the new ECBs there is a benchmark rate which having addition of 500 basis point spread. For the existing ECBs which is linked to the LIBOR, whose benchmark are changed to the ARR. For the INR denominated ECBs, benchmark rate plus the 450 BPS is their benchmark rate. In the case of rupee denominated ECBs will be prevailing, which is the yield of government of India. And then what are not included in this? Any commitment fee or so ECB we know that are the loans which are taken by the Indian companies from the foreign sources in the foreign currency or in Indian rupees. So what are the types of ECB? That is FCYDC, foreign currency denominated ECB, or also the INR denominated ECB. Who can borrow this? Eligible for the FDI, startups, port unit in SEZ, CIDB, Exim Bank, and registered NGOs. And then how to convert ECB to the equity? That is allowed under FDI automatic route. They have to follow all the pricing and sectoral cap rule. They require the lender consent, no extra cost is there. Foreign investment made simple, and there are types of foreign investments are there. FDI, which is having the long term, for the long term purpose in a listed company. Then FPI is there for the short term, less than 10% in the listed company. Who regulates what? See, DA, these are according to the NDI rules. RBI do reporting. DIPP is there for the FDI policy, and for the SEBI there is SEBI is following these rules. Basically there is also a number of there is also a concept. FDI is what? Foreign investment, and FPI. Then Department of Economic Affairs notifies the NDI rules. RBI do the valuation and reporting, whereas various types of government ministries do the case requiring approvals, and there is DIPP and Ministry of Commerce, they formulates the FDI policy. Okay. So what are the documents are required for the foreign investment? Application, also FEMA declaration, company profile and NIC code, MOA of Indian economy, company, SWIFT, KYC SWIFT declaration, email, undertaking, and also the FCGPR documents. There are some documents for refund of foreign investment. In this we need these types of documents, and also apart from this, there is some type of startup companies basically, means any type of private company which is there under the Companies Act 2013, and they are recognized by the government, and eligible foreign investors means PROIs, NRI who are resident in Nepal and Bhutan, they are subject for the inward remittance. OCBs who are not under the OCBs, like overseas commercial, like overseas, what are we saying, overseas commercial borrowings of, these are also not under in the RBI's caution list, so these can invest in that. So now overseas commercial bodies, and then some eligible investment instruments are there, like fully paid equity shares, bonus shares, conversion of equity, ECB into the equity shares. Some prohibited sectors that are same, like chit funds, nidhi business, gambling, lottery business, real estate business, manufacturing of tobacco and cigarette, and rules which are governing to the pledge of shares. Here we can say any person who is resident outside India and holding the equity instruments in an Indian company, that person can pledge in favor of bank in India. And any person who is outside India but holding equity instruments in an Indian company, they can pledge in favor of overseas bank. Okay. And then what is the process of reporting of firms is there? First, entity master creation is completely independent of authorized dealer bank. One entity can have only one entity user. Email provided, all the communication happen via email. Entity user named in the authorization letter. RBI office have the jurisdiction over the registered address of the entity. Figures of the existing shareholding should be correctly captured, and technical issues, there is a email available. So that is the thing in this. Okay. Let's talk about the ECGC. Okay, in just 1 minute we are going to start this ECGC. Just a water break of 2 minutes. Okay. Now let's start with the ECGC. Here, ECGC is a credit guarantee institution that is only set up for the promotion of exports by just protecting the exporters from any type of financial loss, which is uh, which is basically due to the buyer's failures to pay or due to the problem of any externalities in the country of import, by issuing various types of policies to the exporters. At the same time, ECGC issues various types of guarantees to the bank financing exporters, which protect banks in the case of loss from their advances to exporters. So it is a government owned company that is under the Ministry of Commerce and the Industry, that provides export credit insurance. It supports exporters and banks by protecting them against any type of payment risk in the international trade. So why do we need this ECGC? Obviously, exporting is a risky process. So payment may be delayed or not received. Why? Because of political problems, because of economic troubles, because of health emergencies, because of fraud, defaults, legal issues. So ECGC insurance lets the exporters trade confidently. What are the types of risk are available in the international trade? Buyer risk, obviously the one of the biggest risk is buyer risk, where the buyer unable to accept the goods. Say I am not interested in accepting the goods. The seller faces risk related to the non-acceptability, non-payment, quality acceptance, credit risk, etc. Seller risk is where the buyer faces the risk relating to the seller not shipping the goods after receiving advance payment, may ship the poor quality goods. So that is the seller risk. Shipping risk, if the goods stolen, damaged, misrouted, port strike, piracy or accidents are there. Other risk are credit risk, if the buyer is become insolvent, does not able to pay the amount. Legal risk, when there is a ban. Political or country risk, when there is a war or forex shortage is there. Operational risk is there, factory strikes, system failures are there. Exchange rate risk is currency value when drops down. So what are the country risk categories? ECGC country risk categories. So there are some 8 categories. Insignificant is A1, low is A2, moderately low is B1, then moderate is B2, moderately high C1, high C2, very high D. So open, that is comes in the open cover, this is in the restricted cover, and D1 is the also the restricted cover of group 2. How banks handles this country risk? By obviously following the RBI guidelines. Whatever RBI say, they do work according to the RBI. They check the country's rating by ECGC rating. They provides the provisions if 1% exposure is there one country. How to manage this trade risk? ECGC policies are there. Forward contract option futures for the currency risk are there. Foreign currency account is there. Then who is export credit? What is export credit insurance? It is like a safety shield for the exporters as well as banks. Export credit insurance is a safety shield for the exporter as well as for the banks, because buyer if not paying the things on time, so that things lead a problem for exporter. there is a problem in the buyer country, like war, civil unrest, import restrictions are there, which makes importing or exporting, which basically exporting, they are doing the thing for exporting. So obviously it makes the exporting safer and helps the banks in lending easily to the exporters. So who provides this insurance? Many countries who having the special agencies, they are providing the export credit insurance. But in India, ECGC is there who is providing the insurance. Other include USA have Exim Bank, France has Coface Bank, Germany have Hermes Bank, UK have ECGT Bank. So in ECGC Limited, India's export insurance, basically in 1957, ECGC is ERIC, that is Export Risk Insurance Corporation, that renamed to the ECGC Limited in 1964. It basically aims to provide safety to the exporter. It works for the exporter. It also reduces any type of trade gap. It helps in financing the exporter so they can do anything without losing the fear of losing money. It provides the updates on buyer credit worthiness. It offers the insurance and guarantees for the various export related situations. So what are the key services that the ECGC provide? Insurance, policies and support, and export factoring for the MSME, so they can manage their working capital, they can manage their protection, credit protection, they can do collection. For banks, it covers the packing credit, port shipment credit, overseas lending. It also helps banks in offer the safe and in the confident manner. What are the types of the ECGC policies? So starting with the standard policies here, types of policies. Standard policy. See, these standard policies of ECGC provide cover for the exporters for short term exports. In this, shipment is there, which covers commercial and political risk. Shipment related to the political risk is there, which only covers the political risk from the date of shipment. Then comprehensive risk policy, that cover commercial as well as political risk from the date of contract. Then there is political risk contract, just cover the political risk from the date of contract. But it also having some types of risk like commercial risk, also political risk. But standard policy does not cover the risk which are the disputes raised by the buyer failure just to obtain the necessary import, default or insolvency, exchange rate fluctuation risk, and the failure of the exporter to fulfill the terms and condition of the export contract. These things are not available in this. Then there is a small exporter policy issued by the corporation for the exporters. This is a declaration type of policy and it is issued to cover shipment that is made in the period of 24 months only. And it is not covering more than 50 lakh type of turnover. It is not covering that type of policy. Okay. So that is not covering more than 50 lakh, and this policy provides cover against commercial risk, covering insolvency of the buyer, failure of the buyer to make the payment due within 2 months from the due date. So we can say that for exporter with expected annual exports under 50 lakh, it is valid for 12 months. It is easier term made for small businesses. It covers the similar risk as the standard policies. Quality disputes are excluded. Here loss is there just due to exporters own policy or negligence. LC issues due to the document problems. Then there are some more policies, whereas specific shipment policy, it is for exporters sending goods on short term credit, maximum for 180 days. It covers every specific shipment or buyer, and it covers commercial and political risk. For government buyers or LC backed securities, it is only political. Then you can see there is export specific buyer policy, which covers all the exports to one particular buyer. It is very helpful when you don't have a standard ECGC policy, and it is a type of buyer wise commercial plus political risk. Buyer wise political only, it covers buyer wise LC plus political risk. Then there is a buyer exposure policy for large exporters to protect the risk exposure to one or more big buyers. It is available for both LC and non-LC transactions. It is type of a banker's almanac to check the financial health of LC opening bank. Then export turnover policy for the exporters who having the 10 lakh or more, paying more than 10 lakh as a annual premium. It encourages high volume exporters through discount and simplified filling. It is only valid for 1 year. Then there is a consignment export policy for the goods sent and stored overseas before they are sold. For those goods who are sent and are stored overseas before they are sold, stock holding agent, goods are stored by third party agent overseas, same as the multinational operation. It protects against losses during the delayed sales cycle. Then there is IT enabled services policy for those exporters of IT services to one client only. It is valid for 12 months, which covers the losses from political risk, commercial risk, or LC issues. It covers the 80% of losses and bonus available if no claim is there. Policy is there for the SME sectors also, for the small manufacturers or the services providers who are very small. They are covered into the MSMED Act, which covers 90% of the risk. Very simple and easy for small business to operate. So ECGC is there just for helping the exporters and banks by ensuring that export credit, they protect them from losses if buyers don't pay or do any type of delay. Then in this packing credit insurance, which is a product of the ECGC, any loan which is given to exporter just for the manufacturing, processing, purchasing, or packing of good means export is there against a firm order or letter of credit which qualifies for packing credit guarantee. It is only issued for 1 year. The claim is payable in the case of pre-shipment. Bank is required to notify the limits are sanctioned to their exporter customer within 30 days. Then there is export production finance guarantee. This guarantee cover the advances that is given by bank against any incentive receivable and pre-shipment stage. See, packing credit insurance that covers pre-shipment loans, packing, processing, buying the raw material is there. It claims possible is claimed the possible if not repaid within 4 months of the due date. Export production finance guarantee means helping the banks when giving loans specifically for production that is meant for the export. And in post shipment export credit insurance, it covers all the loans after the shipment. It is only valid for 12 months. It protects the banks if exporters fails to repay after the export. Then export finance guarantee, which covers the post shipment credit against the export incentives, like there is a duty drawback. An export performance guarantee, which counters the guarantee to banks for performance related guarantee for the bid bond contract performance customer. So many guarantees are available here. So basically ECGC covers 90 to 90% of the risk, and some countries are here, like open cover, restricted cover. What to do as exporter? Check the policy validity, submit the monthly shipment declaration, avoid the shipping to the buyers, file claims with 360 days, don't offer any discount or settlement without ECGC approval, get approval from extending payment due dates or exporting to high risk countries. Exim Bank, that was born in 1981, there is only one goal: to help the Indian businesses grow in international market by providing the money. Why do we need Exim Bank? When Indian companies trade with the world, obviously they need money to make the product. They need money to support the selling in abroad. Safety net is there against the risk. So Exim Banks comes in as a friend or financer for both the big companies and the small companies. What are the basically main roles of Exim Bank? Make the Indian products global, provide the financial support, supporting the overseas investments, sharing the export data and advice, and solving the problems. So what are the Exim Bank products? Buyer credit, you pay, you buy, we pay for you. That is the Exim Bank product. Exim Bank give loan to the foreign buyers. Why? Just for making the foreign reserves more. So in that, Exim Bank give loans to the foreign buyers so they can buy Indian goods or services. This thing helps the Indian exporters that they will getting the order, as well as forex reserves is also increasing. Then corporate banking, which is a support for Indian exporters. It is type of a pre-shipment. Pre-shipment, post-shipment loans, equipment financing for the factories. There is a special support for SME, creative industries are there, and also the finance for the R&D and innovation. Then there is a lines of credit. Lines of credit like big credit lines to other countries. Exim gives credit to the foreign governments or banks. In return, they must buy the Indian goods and services supported by the Indian government. Like there is a LOC. If I can define in other words the LOC thing, uh, line of credit. This is an important concept. Let's see about that in a little bit detail form. So Exim Bank, we know that Exim Bank is established in 1981 under the Export Bank of India, and basically buyer credit LOC is a type of a Exim Bank extends their line of credit to enable the Indian export to enter into the new geographies, or they can expand their business in the existing export market without any type of payment risk from overseas importers. Then overseas investment finance, it is basically like Exim Bank helps in enhancing the export opportunities for India and driving the economic growth of the nation. Okay. So that is the thing in that, which basically Exim Bank is there just for help the things. Then Exim Bank, Export Import Bank of India, established in 1981, help Indian business exporters and services. Um, then Exim Bank supports some civil construction projects, turnkey projects, consultancy and design services, and fund machinery and other thing. Then there is a concept of EVDLP, where there are so many vendors, so exporters help their vendors to grow, so vendors attract with the export business and they will give the new ideas. Exim Bank give loans for the machine, tools, training vendors, vendor working capital. There is a real time example. India gave 500 million line of credit to Sri Lanka during its fuel crisis. Why? Because Sri Lanka used that funds to buy fuel from India. Then India got the export order. Also, India helped the neighbor also. So why Exim Bank matters? It is the backbone of the India Export Bank. Then supports from India to export to the expansion. It provides money, market access and as well as the protection. So what is line of credit? Exim Bank gives credit to the foreign department so they can buy goods and services from Indian exporters. Indian exporters ship the goods in which they get instant money from the Exim Bank, and foreign government then pay in a slow manner, like in 3 to 5 years. So what is the step here and how the LOC work? Foreign country signs the LOC with the Exim Bank. Indian exporter receives order from a local agency in that country. Then Exim Bank confirm LOC availability to the exporter. Exporter gets pre-shipment loan to make ship goods, and after shipment documents sent to the Exim. See, there are some RBI forex data returns, FETRs, fortnight forex flows, BAL balances are there in the Nostro Vostro. Then there is a stat 5 and 8, that is FC NRB NRE NRO account, NRD CSR, NRE deposit data, IBS is there, that is assets and liabilities, ECB2 foreign loans, trade credit, that is basically info on buyers and suppliers credit, LRS data is there, which is individual remittances up to US dollar 2,50,000. What is RRA? Regulatory Review Authority, which removes all the duplicate rules, makes the data 100% online, cut any type of unnecessary returns. So full form, full exchange foreign exchange management act that came in effect in 1st of June 2000. It replaced the FERA. Objective is just facilitate trade and payments and maintain the forex market. Who can send the FEMA and remittances under the FEMA? So some are the prohibited remittances, same as per the RBI and as per the LRS and FPI investment, the things are same. Under the schedule 1, no lottery winning, no horse racing income, no lottery ticket purchase, no export commission to the overseas subsidiaries, remittance of interest on certain account is not allowed, payment for callback services also not allowed. But schedule 3 second is saying cultural tools is included but need approval from the government there. Foreign print ads are there by state and PSUs. Hiring the transponders, TV transponders, then ocean transponders, ocean transport by the government. These all things are needed the approval of the government. Then what are the schedule 3rd is saying foreign travel is approved by the authorized dealer banks. US dollar 2,50,000 up to US dollar 50,000 is allowed under the LRS. Study, job, emigration abroad is allowed. Medical treatment is allowed. Business trips are allowed. Gift donations are allowed. Some are the foreign travel tips, like in the case of Nepal and Bhutan traveling, no type of forex is allowed in that case. If someone is carrying the forex note, they have must be 3,000 normally, and in the case of Libya and Iraq, US dollar 5,000 is okay. Possession limits only US dollar 2,000. You can possess this much of foreign currency, no limit on the coins, as much as coins you can possess. Payment mode, if is greater than 50,000, then the payment will be by the help of check, DD, demand draft, NEFT and RTGS. And any unspent forex must be returned back to the India within 180 days, and it must be in the RFSC account. So overseas direct investment means Indian companies, they can invest abroad in the joint ventures, in the wholly owned subsidiaries, but the route must be automatic or approval. ODI index indicates the long term interest in the foreign business. So just think about the ODI, how they are sending the money abroad to own a piece of foreign company, like planting a tree in another country and grow up your business globally. So that is the ODI, sending some amount of money just to get a little bit piece of any foreign company in shares. So uh, who can control ODI? FEMA, section 6 subsection 3 RBI is saying that FEMA can control this ODI. Who can decide that who can invest in abroad, what kind of foreign assets can be bought, how much foreign exchange can be used, and all these are thing is consulted with the central government. Who can invest? Any Indian party can invest who is registered in the India or OR, who are registered in the India, and any body which is conducted formed under the Act of Parliament. These are eligible to make the ODI under automatic route or approval route. In the automatic route, there is no prior RRBI approval needed, and approval need means where approval route means where the RBI permission is needed. So how can the ODI done? Shares of a foreign company you can buy, you can invest in joint venture, you can invest in wholly owned subsidiaries. Investment methods are market purchase, private placement and the stock exchange. And the goal is there to create a long term business interest in that of foreign company. So in India, is suppose if someone is planting the trees abroad, ODI is that seed money and the foreign company is the orchard, or, or the RBI is the gardener, which ensures that orchard grow right. I don't know the correct pronunciation, I'm not saying this orchard or orchard, I will check it. So it is like ODI, you can invest in other company, in foreign company, joint venture, wholly owned subsidiary, and you can do the market purchase, private placement, stock exchange. Who can invest abroad? This thing we have learned. So how can you fund the investment? Obviously by the help of foreign exchange from the authorized dealer banks you can use. You can use the export earnings, you can swap the share, ECB, FCCB, ADR, GDS, so many methods are there, and 400% limit is there, but for 6 and 7 1 there is no limit applicable of 400%. In the automatic route there is no RBI approval is required, but in this authorized dealer bank files with the RBI will give you the unique code. And part 1 is having the new investment, part 2 is having the annual performance report, part 3 is these investment sale or merger report. So there are some must know rules. use one authorized dealer branch only, and all the transaction must be happen through that authorized dealer branch only. They have to track all the documents and the transaction. Then they will get the certificates in, like, you have to share the certificates in 6 months. Then any income which is repatriable, that should be done in only 60 days, and file the APR in by June 30 every year. So this is the fixed date in which the APR is submitted. So that thing is clear. Now let's move. How many types of foreign currency accounts are there available in the India? See, exchange earners foreign currency account, that is basically residents, individual, firm, companies, they are earning in foreign currencies who can open this account. They can hold their foreign earnings without converting them to the INR. No interest is there. They can be used this amount for the import, travel services according to the RBI limits. Then there is a RFSC account, means returning NRI can open this account who are now settled in the India. They can park their foreign currency, like they can park their salary, gift, inheritance, which whatever they earn abroad. They can bring the funds into the India legally, which are earned legally abroad. Okay, then there is a RFSC domestic account. Resident who is getting the foreign currency as travel leftover, as a gift, or honorarium, they can park this amount in the RFSC domestic account. They can keep, they can use the leftover foreign cash in legal way. They can't use business related money, and no interest is there in this account. Then DDA, diamond exporters can open this DDA. Why? Because diamond exporters who have the turnover more than 3 crore, they can open this account in the past 3 years. They can manage the export import without any exchange loss. They can also open 5 different DDA accounts with different authorized dealers. They are allowed to open up to 5 DDA accounts. FEDI, that is a SRO, self-regulatory organization, established in 1958 by the RBI approval, and self-regulatory body for forex India, forex business in the India. They are issuing the foreign trading rules. They are basically here for training the bank staff. They is here for advising the member banks. It sets the indicative exchange rates also. And ADR is there. What is ADR? American Depository Receipt. That is basically any foreign company shares the trade, any foreign company share the trades in the US market. Who can issue? US banks can issue. Okay, so there are types of types are there, like OTC is there, and these are listed on the exchange. These whatever the ADRs are there, they must be listed on the exchange. Level 3 is there, public offering, highest SEC compliance. They can also raise the capital. Okay, then GDR, who are the siblings of the ADR, shares of a company that are listed in the international market. These are the GDRs. Currency is like US dollar or euro. Where basically they are traded? In the Europe basically they are traded. Purpose is raising the capital with less cost and better access to the global investors. Now FCCBs like foreign currency convertible bonds, bonds which are issued in the foreign currency and that bonds are convertible to the equity they can issue. Why this is useful? Just to raise the foreign capital with the debt features and foreign equity options. Who can buy? Foreign investors and those who are there for hedging the funds. It is basically regulated by the FEMA, RBI and IFRS. Like then foreign currency exchangeable bonds, bonds that are convertible into the shares of another company in the same group. Indian companies with listed group companies, and maturity is basically 5 years. Why? To unlock the value from group companies without diluting main equity company. Okay, so that is the FCEBs. Now let's talk about the IFSC, International Financial Service Center. That is a global bank inside the India, and it is mainly doing the international business. Okay, it is a very special place set up to deal with the foreign money, investments and the financial services. Who can do the IFSC's offer? IFSCs help in raising funds from foreign markets. It helps in managing the investment for mutual funds, pension funds and etc. Also, it manages all the wealth for high net worth individuals. It helps the companies in managing the taxes across the borders. It manages the global treasury and risk. It supports the merger and acquisition across the countries. Why the IFSCs are there in the India? What are the IFSCs are there in the India? See, India's first and main IFSC are there is in the Gandhinagar, Gujarat, and it is started on 5th of December 2019. It has 225 plus companies which include bank, insurers and the investment firms. 3 public sector banks are there, 9 private sector banks are there and 3 multinational banks are there. Why this gift city is important? Obviously it connects 30 million strong people from India. It is very low cost fundraising which is raising globally. It builds the global in-house center for the financial firms. It offers the financial services like trade finance, capital market, retail banking, forex derivative, etc. So what is the meaning of IBU? IBU, that is IFSC banking unit. It is a foreign like branch of an Indian bank that is settled in the IFSC. What are the rules for the IBUs? See, only banks approved to deal in forex, they can open one IBU in an IFSC. They need RBI permission to start the things. Then minimum capital of $20 million is required. No CRR or SLR is required. They can deposit only from the non-resident and they can use the funds in India or abroad. No saving account, no cross transactions are allowed. Deposits are even not insured here. KYC and AML rules apply in the Indian banks only. Now, what is the meaning of IFSCA? International Financial Service Center Authority, which is a super regulator, and that is basically set up in 27th of April 2020, Gandhinagar, Gujarat. IFSCs were regulated by the RBI, SEBI, PFRDA, IRDIA. It handles everything in one roof, and it makes easy to do business in the IFSC. It creates a world class financial hub. It is like a bridge between India and global finance. So, what is the meaning of IBU? IBU is like a mini foreign bank branch of an Indian or foreign bank which is set inside a IFSC. IFSC banking unit, IBU, and here parent bank must have at least US dollar 20 million capital. They need the license from the IFSC. They also need no objection certificate from home country regulator. They need the letter of comfort from the parent bank. No type of cash reserve ratio and statutory liquidity ratio is needed here. They have to follow the LCR and NSFR for the liquidity. They have to maintain 3% retail deposit reserves also. Now, what can an IBU do? IBU basically they can deal in foreign currencies only. They can work with non-residents, Indian companies, joint ventures, wholly owned subsidiaries who are in abroad. They can work with only retail and corporate customers. IBUs cannot open any saving bank account. They have to issue they can't issue any checkbook. They can't join any Indian onshore payment or forex market. They ask for the RBI for the liquidity support. Also, IBU provide the forfeiting and factoring services. Here they can open the current account for the IFSC units and the NRIs, and they can act as underwriters for Indian companies where bonds are issued by the abroad. They can also use the escrow account for the GDR and ADR subscriptions. Now, basically, the thing is there. What is the meaning of escrow account? Right? What is the meaning of escrow account? So, escrow account means a financial arrangement where a third party hold the funds or assets on the behalf of two parties which are involved in a transaction until all the conditions of agreement are met. So, escrow account ensures that funds are not released until both parties have fulfilled their obligation. It protects both buyer as well as seller. Okay. So what are the relaxations are there from the FPIs at the gift city? FPIs can trade freely in stock and commodity derivative. There is 22-hour exchange operations are available. No securities transaction tax, no commodity transaction tax, no extra paperwork is required. Short-term capital gains tax waived on the derivatives. Retail investors allowed to trade, that means more liquidity required here. Right? Now the concept of digitalization, that is okay, important, because we know that in today era digitalization is very important. So using the technology to transform the banking services, especially which are important in the international banking, where speed, security, everyone know that digitalization is one of the most important thing, and everyone is now enjoying this digitalization. Why? Because of modern technologies. Everyone finds their comfortability in the digitalization. They don't need to go to the bank for even the small purposes. And international banking basically where speed, security, global access are very crucial. Competition is increasing from tech startup and fintech firms. Banks need to transform fast, or uh, if they are not transforming themselves and they are not adopting the things, obviously the competition is there in the market. So if they want to compete, they have to adopt the changes. So how to build a digital bank? Obviously by defining the mission, vision and goals, assessing the digital maturity, re-engineering the IT architecture, aligning the people, processes and the platforms. Customer here are the first, which give the flexible and convenient services, in which uh, models are provided, plans are there, budget and timelines are there. Appetite means willingness of a bank, how much bank can take a risk, and also there are measurable returns. So what are the ideas for better digital transformation? Obviously bank should aim here to be relevant and to be flexible to the customers. They balance the speed, uh, and they have to create the digital ecosystem. They have to hire the digital savvy staff, and there is evolution of the tech in the Indian banking. You can see that evolution here. Benefits are also there of digital banking, limitations are also there of the digital banking. If someone wants to remit the money online which is coming outside from the India, so there is a safe portal which is used by the NRI or anyone overseas to send money into the India. Then benefits are there, very fast and very secure, 24 into 7 access is available, transparent exchange rates are there, and trade finance portal is there for the import, export and import. Like there is a web based portal for managing the trade. In this it includes paperless and eco-friendly. It allows the buyer credit pre and post shipment services. It supports the bulk upload, maker checker and dashboards. And then there is a foreign exchange rate portals also for the approved countries who can deal with the foreign exchange. Real time forex business is there. Direct connect with the bank dealing room. It have to follow that regulatory documentary submission, or they have to deal in the auto cancellation. Real time rates are there, audit trail and MI is there, expert advices are there from the dealers. So then EDPMS means, EDPMS I already explained you, IDPMS is there. Fintech is important, that is a financial and the financial plus technology. Basically means using the technology to make the things faster. And how this is used? By sending the money, by giving the loans, by managing the investment, by detecting the fraud. So banks use the chatbot, mobile app, AI, ML for better customer experience. So this is the timeline snapshot where how the fintech evolved from 1866 to 2010. And in India, this is the highest adoption rate are there in the India. How to use the fintech, how fintech technologies are there in use? AI is there, then big data and data analytics are there. RPA, where robots handle the routine task like data collection, sending emails, managing the transaction, following the regulations. So blockchain is like a secure digital notebook that records all the transactions. No paper, no fraud is there, real time updates are there. And here our trade can be done by using the blockchain, by doing the documents check, faster documents check, no middleman required, proof of ownership is visible, smart contracts, automatic settlements are there. So what are the challenges are there in the fintech? Regulatory doubt, cyber security threats are there, obviously data privacy concerns are there, or we can't remove the human involvement completely. So with this our module A is completed. um, just a second. Okay, let's take here just a 10 minutes break, then we will start our module C. Okay, only 10 days, 10-minute break, not 10 days, sorry, 10-minute break, then we will start our module C. Okay. So let's start module C, and we'll complete the module C for completion of today's class. So let's start with the class. Just a second only. So we are going to start now Treasury Management. Obviously, earlier in the past times, we used the treasury by just having the cash, that okay, enough cash is available, our daily demands are fulfilling, we are using the extra money in a very wise way, and we can borrow the money whenever we need it. So it was seen as a support function, means taking care of rules and regulations related to CRR as well as SLR. So how these things will become a change, come with the changes after India reforms in the 1990s. Now this treasury become more important. After India's economic reform in the 1990s, this treasury become important. Now it is a profit center which basically makes the money for the banks by different types of activities, by trading, investing, advising the management. So everything they start to take charge a amount of money. That is basically a bridge between a bank main job and the financial market, that is a treasury. Now then one more concept is there, that is the concept of integrated treasury. Earlier cases, foreign exchange, securities, they were separate, but now they are combined and they become the integrated treasury, which handles all the money market like short term funds, securities market like bonds and shares, foreign exchange like the currencies. Why integrated treasury? Obviously deregulation is there, more competition is there, globalization is there. So now rupee can be now easily converted to the other currencies. Now bank can raise the money from outside the India. Money and risk are now managed across the currencies and the markets, right? So we can say that the thing is there. So we can say that the integrated treasury is important. So why integrated treasury? Just because of globalization and deregulation. So what are the functions of de-integrated treasury? For meeting the requirements of CRR and SLR, these are both two important ratio. They are here to manage the global cash flow, whatever the local and foreign currency. Merchant services are there for the customers, for the forex, loans, investment advice, trading and investing in the money, forex and securities market. Risk management is there by using the tools like derivatives. It helps in asset liability management and fund transfer of pricing. So what are the three main roles of the treasury? Liquidity manager, that everything must be available. Profit maker, which is trades for profit using the market knowledge. Then there is a risk controller, which manages all the internal tasks and help the clients in managing their things too. Globalization means, globalization is one of the famous concept which connects all the domestic market with the rest of the world. In this, money is moving freely between the countries just for trade, only for trade and so many other purposes like investment purposes. Now some capital flows, that is here portfolio investment. Here foreigners are buying the Indian shares or the bonds. Direct investment, where the foreign companies starting businesses in the India, external borrowings, where the Indian companies borrowing the money from the abroad. There are so many global issues where the Indian companies selling the share and bonds to the foreign investors. And then merger and acquisitions, like the companies from different countries joining or buying each other. So why it is matter to the treasury, why treasury is important in that case? Obviously treasury is important, and integrated treasury is more important, which makes the things easy for the banks to managing all the things like in a great way. So treasury is important, but integrated treasury is also important. So here we can say that treasury we need to just manage the both currency as well as the rupee currency and the foreign currency. And because of this globalization, these Indian treasuries deal with the global interest rate, exchange rates, and the risk management tools like derivative. They are here to help the corporate clients manage the foreign payments, loans, as well as the hedging. So what are the risks of globalization? Obviously, when there is too much foreign money enters or leave quickly, they can cause the problem. Like stock prices or currency value swing wildly. This was seen in the East in Asia crisis of 1990. So central banks like RBI, they have to regulate the flow to avoid these types of financial losses. Now what are the tools and products that are used in modern treasury? Currency derivative, interest rate future, credit default swap, cross currency future. Then treasury means when banks treasury helps in managing all the cash needs, in borrowing as well as in lending the short term money. Now it handles the profit part also, it generates the profits also for the banks. In basically there are three departments: money market, forex, and investment. But now all these treasury converted into one treasury, which is more powerful and become more flexible. So why is treasury profitable? This is less risky, and less credit risk is there. There are few staffs that handles big transactions. It uses the borrowed money smartly, that means more returns are there. What are the main sources of treasury? Forex dealing, money market, investments, trading, arbitrage, and the structured products. So suppose there is a bank who is earning 3.5% in the India, it uses the US dollar and INR swap and earning the 4.32%. So this extra 0.82% is a pure arbitrage gain. So treasury help in deciding how banks different departments should pay for using funds, and it helps in managing risk and price it correctly. So how this treasury organized? By the department at the head office, by the specialized treasury branch. And who heads the treasury? Senior management, that is general manager, or there is a chief treasury officer, CTO, who have to do directly reporting to the CEO or CFO. And what are the main divisions of this treasury? Three big areas are there. Main, that is front office, back office, and the mid office. Front office, that is dealing room, which executes deals, buying and sells the currencies, securities, that is reporting to the chief dealer. Back office is there, which confirms the deals, settles the payments, maintains the records, and they report to the treasury admin head. Then mid office is there, which is basically doing the monitoring and reporting, and here they report to the head of risk management. So who does what? Dealers who are there in the front office, they do the actual trading. Back office ensures everything is confirmed. Mid office is like a risk police, they track limits, exposures, and ensures nothing goes off to the track. Then some other treasury units are also there. Okay, so investment department, account system, remittances, they all are doing work with the admin work. They do the proper reporting, recording of the things. So forex market means where the currencies are bought and sold, and it is the most liquid market in the world. Forex market, 24 into 5 days available, and transparent, virtual, as we know that in the first chapter is that spot market. If the settlement in this type of transaction, settlement is done after the 2 days. Okay, and sometimes trades are settled in the ready or cash deal or in the tomorrow deal. Then forward market, you lock a rate today for a transaction that will usually happen later. It is used by importers, exporters, just to protect against any future currency change. So banks and treasury, they have to manage their risk or profit from rate differences. So what is NDF? Non-deliverable forward for non-convertible currencies like INR or RMP. So here basically what happened, using the non-deliverable forward, just cash settlement has happened in this. Foreign investors want to hedge the risk. They hedge the funds, banks and the speculators, people who are operate in offshore and onshore market, they get the profit from the rate gaps. Then what is the future? There is a contract in which there is a promise to buy or sell at a fixed price but on a future date. Buying and selling is done, but prices are fixed and the date is of future date. So suppose if you if you lock a deal today, so you have to buy this US dollar at 85 after the 1 month. What matter if the rate is at that time is 80 or 90 or 95? That rate is locked. Okay, so futures are traded on the organized exchanges. They are terms like size and expiry are standardized. Both buyer and seller have to deposit the margin. No actual deliveries happen there, and there is no risk of counterparty. Then what is option? Option basically gives you the right that you can do this thing, but this is not your obligation. You have to buy, you have to sell something at a fixed price on or before a future date. There are two types of options. Call option means you have the right to buy. Put option, you have the right to sell. There are two styles, American option and the European option. American option, you can use it anytime before or on expiry. You can use on expiry date only. So if suppose you have buying the call option at the 85 and this US dollar goes 88, so you can use your option and gain. If it falls to 82, so you can ignore the option. You are not forced to buy. So buyer has rights, but seller has obligations if the buyer decides to act. Now swap, that is the currency or interest rate switching. Swap, it is a combo deal where you buy currency in one deal and sell it to the another deal. either for the future or the same time. You buy in one deal and sell it into the another deal. Suppose swaps are involving the full convertible currencies which do not allow any type of interest arbitrage, because forward premium is equals to interest rate difference. Okay, and for avoiding any mismatches in the cash flows, basically, so basically, if you want to get fund in another currency, you have to invest rupees while holding the dollars. Swaps means involvement of fully convertible currencies do not allow the interest arbitrage. What are the investment of foreign exchange surpluses? Banks have foreign exchange currency like US dollar and euro. So obviously you can, in this treasury team, have to manage all the things in a safe short term returns while ensures the liquidity. Whatever the foreign borrowings are there, overseas branches earnings are there, and where these funds can be invested, obviously in the short term investment, in the interbank loans, in the nostro accounts. And what is the treasury role in the lending and rediscounting? Treasury does not improve any type of loan, but it check if there is any availability of the foreign currency, if there is any cost of the funds are available. Then rediscounting means, if suppose bank is there, a bank is buy a bill from a customer, then bank B refinances this bill and give money to bank A. This is called risk rediscounting. Like, risk is completely on the bank A, not on the customer. So treasury is basically earning slightly higher returns than typical interbank loans. So what are the money market products? Money market, that means where borrowing, lending money is there for less than 1 year. It is used by the banks and the large institutions. You can see type of interbank money market instruments: call money, where the overnight is there only for 1 day; notice money, 2 to 14 days; term money, 15 to 1 year. And then, what are the meaning of treasury bills? Treasury bills are a type of like short term loans. Treasury bills, we can say, are a type of short term loans which is basically used for the things that is useful for the bank. Like, we can say in the other words, treasury means these are the money market instrument which is issued by Government of India as a promissory note with a guaranteed repayment at a later period. Okay, and in this short term loans, that gives to the Government of India, which promises to pay them back after a few months, issued by RBI on the behalf of Government of India. There are maturity options, that are 91 days, 182 days and 364 days. How do they work? T-bills are sold at a discount. You have to earn the difference between purchase price and the face value. Suppose someone is buying a 91-day T-bill at this amount, but after 91 days you will get this 100 rupees. So this 0.74 is giving a yield rate of 2.99%. Who can invest in the T-bills? Banks, primary dealers, mutual funds, corporates, individuals. And what are the schedule of this issuance? 91 day, that is issued every Wednesday. Then 182 day to 365 day, that is basically every alternate Wednesday. Why are these T-bills used for the banks? These T-bills are risk-free. They are having the better returns. They are very liquid. Here it is used for the benchmark for the other debt instruments. And how are these T-bills are held and the settled? Obviously in the electronic form. They are also having the subsidiary ledger account with the RBI. They can hold through the depository participant. They are settles via the CCIL, that is Clearing Corporation of India. If the maturity date is a holiday, then T-bill matures on the previous working day. Now the cash management bills. CMBS, basically what is the meaning of cash management bills? These are the short term debt instrument which is issued by the central banks by doing the consultation with the government to just address all the temporary cash flow mismatches and provide the short term funding. Okay, so they are very short term loans which are taken by government of India to handle the temporary cash flow problems. They are having the tenure less than of 91 days. They are sold at a discount like T-bills. They are announced by the RBI just one day before the auction. Settlement is there T plus 1 day. Retail investors here can not buy this by non-competitive bidding. CP, commercial paper, is a short-term loan paper issued by the companies to raise the working capital money. Here who can issue? Who having the credit rating of A333, they must have standard asset classification. Large companies, NBFCs, LLPs, trust government entities, they can issue this. Main feature 7 to 1 year, 5 lakhs, and it is must be scheduled bank. And here in this case buyback is allowed. Then there is a CD, a short debt instrument which is also issued by the banks or the financial institutions. Why? To borrow money from the investors. So scheduled commercial bank, small finance bank and RRBs can issue this CD. Then what is the meaning of market repo? See, repurchase agreement is a way in which banks or financial institutions can borrow or lend the funds by using this securities as a collateral. Now the most important topic, traps, tri-party ratio. There are basically, if we talk about the traps, there are 3 parties are involved. Borrower who wants the cash, lender who has the extra cash, tri-party agent like a CCIL which is act as a referee and a matchmaker. So CCIL and CDS is basically platform where repos are happen, and it is replaced the older CBLO system. It ensures that the collateral should be used in the great manner. Funds and securities are happening without any problem. They are moving smoothly. Everything is safe and everything is settled. Tenure is 1 day to 1 year. Participants are there, bank, corporates and even NBFCs. So what are the key feature of the NBFC? CCIL, which having the borrowing limits, trades which are mark to mark daily, MTA trades which are marked to marked daily. Means here if we talk about the mark to market, that is the meaning of, that means basically the thing which is basically a accounting method that revalues the financial assets and liabilities to their current market prices at the end of each trading day. Okay, So then if prices fall, more margin is asked from the borrower, and here CCIL guarantees settlement. Then what is the why RBI uses this repo and reverse repo? Repo, in which RBI gives cash to the banks, but in reverse repo, bank pack their extra cash with the RBI. Bank is saying that I have this that much of cash, extra cash, so keep it this with you. What are the tools which are used in the monetary policy? Repo, reverse repo. Repo injects the liquidity, reverse repo absorbs the liquidity. So you can see the repos in the LAF fixed rate overnight. There are liquidity, daily liquidity is the thing here, and it is updated twice. Variable rate, which is based on auction as per the requirement, as per the liquidity. 14-day here, this is weekly liquidity balance check and it is available weekly. Long term rate, it is for durable liquidity, and RBI discretion is needed here. So you can see the current ratio, current rates. Repo rate, current rate is 5.40%, whereas reverse repo rate is 3.35%. Corridor width is 205 basis point. And if I talk about the SDF, park and earn overnight. What is the meaning of SDF? Like park and earn in just overnight, in one night only. It is standing deposit facility, a total with a tool which is introduced by the RBI to absorb any excess liquidity from the banking system without requiring any collateral. This basically allows banks to park their surplus funds with the RBI for only one night and earn a fixed interest rate. Clear? So it is launched on 8th of April 2022. It replaces the fixed rate reserve ratio repo, and it allows banks to park extra funds with the RBI without giving any type of collateral. It operates overnight from 5:30 p.m. to 12 p.m. even on holidays, and always the interest is 25 bps or below the repo rate. So if the repo rate is 5.40, so SDF is near about 5.15. So no collateral is needed here, not counted for any type of cash reserve ratio, but they are eligible for the SLR. They are uses the CAIIB system for bidding, and they are having the auto sweep function, like funds can come and out automatically, and minimum bid is here 1 crore, no maximum limit is there. Then the concept of MSF. What is the meaning of MSF in the context of banking? MSF, marginal standing facility, a mechanism where banks can borrow funds overnight from the RBI to address the liquidity shortages. It is essentially a safety net for the banks which offer the immediate liquidity support in the condition of emergency condition when interbank liquidity dries up. So it introduced in 2011 to help the banks when they are short or on liquidity. Banks can borrow overnight from the RBI against the government securities. Up to 2% of NDTL is there. Interest 25 basis point above the repo rate. During COVID-19, RBI temporarily increased the limit to 3%, and then after COVID-19 it is back to 2% from the January 2022. So then there is a concept of bill rediscounting. Bank can resell the short-term bills, means there is a loan on a loan. The bill rediscounting is basically a loan on a loan. So if we say that Loan on a loan meaning here bank or financial institution that has already discounted on a bill, then rediscount the bill with another institution, typically with the central bank. So this allows the original institution to gain the access to the funds before the initial bill's maturity date. So that means here they want to say that thing, that this type of things happens between the banks, usually at the money market rate. They lend the banks earn the interest, and borrower here, borrower bank get the liquidity. It also reduces the borrower credit exposure and improves the capital adequacy. And there are low risk because lending can recover from the borrowing bank. Now G6, one of the safest investment with almost 0% risk, is the G6 government securities, and they are basically uh, issued by the central and state government to finance their spending and obligation. These securities are considered as a safe investment option due to being backed by the government. So it is issued by RBI on behalf of Government of India. It also includes state development loans sold via auctions. Price may be more less than face value. Here interest paid on face value, not on the market price, and yield is not equal to the coupon rate, and basically price drops when yield increase, so there is an inverse relationship. So what is the purpose of G6? It helps government finance deposit. RBI uses them in the OMO open market operation, just sell them to absorb the liquidity and buy them to inject the liquidity. Then the cash, the basically reserves of the bank, SLR. What is the meaning of SLR? Statutory liquidity ratio, a regulatory requirement which is imposed by the RBI on the commercial bank, which basically mandating them to maintain a specific percentage of their NDTL, net demand and time liabilities. And this ensures bank have enough liquidity to meet the customer demands and maintains the financial stability. So we can say that here banks invest G6 to meet this SLR requirement. Earlier there is a percentage of 38.5, now it is 18%. It includes SIDBI, NABARD bonds, cash and gold. So you can see the classification of G6 here. HTM, long term holding, book type is banking book, it is not a mark to market. Then AFS, HFT, you can see the active trading, sale possible, trading book, it is quarterly, it is frequently available. So what is the meaning of corporate debt paper? In a very basic way, if I say about the corporate debt paper, so corporate debt paper is like a type of a tool or a type of a thing, we can say, is where that covers a wide range of instruments that traded in the primary and secondary markets. So basically medium long term bonds debenture by the companies or financial institutions are there is it is traded in the secondary market. Investment is better because of better returns. Credit rating agencies CRISIL, ICRA, CAIR, Fitch, Acute and Informix, they check the risk available in that. Then we can talk about the debenture or bonds. debenture, debenture means typically the private sector which is governed by the company law, and this is the most secure. Bonds, this is the mostly public sector but no government guarantee are there, and this is same as the bonds. Non convertible is there. So how many types of bonds you must know? Zero coupon bonds, obviously no periodic interest, floating rate bonds, set up step up coupon bonds, put call option bond, collateralized bonds. So what are the convertible bonds? In which some part is debt and some part is of equity. So investors can convert them into the equity at the fixed price or date. Then equities, there are shares in the company which basically with or without having any type of voting right. Preference share means getting the priority for dividend, that like priority for dividend is there. And here some domestic things in which how markets interact. See, you can see FII and FD, FDI, ADR and GDR is there, ECB is there, LRS is there. So you can see there are different things are there. So there are risk and lessons from the global crisis. Obviously so many things are we learn, banks learn from the global crisis. That's why Basel 3 is there. So these things tells about the globalization risk. These things are basically tells about the forex reserves and the safety of the forex reserves. So what government foreign investments are there India? What governs foreign investment? FEMA governs. And what are the types of foreign investment? FDI, FPI, and FPI means that person who is registered into the SEBI, FII who are treated as FPI. Now what are the prohibited investment areas? Same are the prohibited areas which are there in the LRS, which are there in the everywhere. But citizens Bangladesh of Pakistan, they need the approval. Pakistani citizens entities, they can invest in defense, atomic energy or prohibited sectors. So GDR and GDR is already discussed. Now let's talk about the IDR. Foreign company issued this IDR in India just to raise the funds. IDR are basically in the Indian rupees, and investors in India can buy, sell and hold these IDRs. Redemption is not allowed here. And also RDBs are like, these are issued outside India but they also denominated in the INR. Tier 1 and Tier 2 capital is needed in this, and affordable housing is available, and banks are used this thing only for this. And INR to foreign currency not available. 49% of the total eligible account can be in there in this. Then what is cash reserve ratio? Bank take the deposit from the people and give the loans. They have to keep a part of those deposit as a cash with the RBI. It is like a emergency money that banks can't use for lending. It helps in RBI in reducing money in the system and controls the inflation. Then what is SLR? Banks have to keep this. I told you about the SLR. So you can see the difference. Cash only with the RBI, gold, government bonds, cash are there, comes into the SLR. No interest from the RBI, but their interest earned on the bonds. There is a direct control by the RBI. There is a regulatory cushion. So why this CRR and SLR matter? Obviously RBI controls the liquidity. High CRR SLR means less money to lend, lower inflation. But if there is low CRR or SLR means more money to lend and there is a economic growth. So current rate you can see CRR is 4.5 according to 24-25 and SLR is 18%. Now LAF, that is liquidity adjustment facility, RBI tool. If bank needs money, RBI lends to them. If banks have extra money, they lend to the RBI. These you know that about all the type of settlement system. Then we can see here, banks do the management of treasury by the help of front office, back office and mid office. Then there are some position limits in which it makes the value per transaction. And just a second, here are the position limits. In this, how banks manage the treasury risk: deal size limit, max value per transaction, totally unmatched currency the bank is holding, stop loss limit is there, which is a emergency break. Market risk, we can read in the module B. So the duration is there. See, duration means if the interest move or down, bond prices goes into the opposite direction. Duration tells you that how the bond prices change if the interest rates is change. That means interest or bond price have a inverse relationship. And Macaulay duration, modified duration, these are both the important concept. In this, average times you get your money back from a bond, this tells about that average time. But in the modified duration, it shows how much the bond price will move if the yield changes by 1%. So there are types of derivatives also, like OTC derivative, over the counter, where everything happens over the counter. There is flexible amount, date and terms. It is basically used by hedging the, protecting the real risk, and also the counterparty risk is it is having. Some are the exchange traded derivatives are there, some are common derivative instruments are there. And derivatives means these types of financial tools whose value depends on the underlying assets, whatever is the currency, interest rate, stock, commodities. Four main types are there: forward, future, option, swap. What are the meaning of forward contract? On a future date, everything will be happened according to the agreement. Options are explained here in the class. Swaps are explained. So what is the meaning of FBIL? That is a Financial Benchmark India Private Limited, started in 2014 by the FIMDA, FEDI, FEDA or IBA. Its job is to create and manage important benchmark rate for the financial market of India. Asset liability management, where we do the management of assets and liabilities, are managing all the mismatches even in the maturity or the interest rate. So credit risk is clear. Transfer pricing. See, transfer pricing means where the treasury department of a bank is basically price the internal transactions. Means if I say about the transfer pricing, that is basically an important concept, and question is from there, from the in previous cycle there is questions from the transfer pricing. Basically that allocates the revenue and cost of using funds within a bank to its different business units. Means treasury department prices the internal transaction, in which treasury buys the deposits and sells the loan to other department at the internal price. If a branch get a deposit at 7%, so the treasury may buy it at 6%. So this 1% is borne by the branch. Then if the bank lends at 10%, so obviously treasury buy the loan at 7%. So this 3% becomes the credit risk profit from the lending department. So why it is useful? It helps in tracking the true profitability. It make it easier to manage the interest rate and liquidity risk. It helps in managing all the assets and liabilities. So all the policies must be approved by the board and board level committee. It always aligned with the rules and the market codes. It must be reviewed early and it is monitored by the senior team. So this is all about the treasury management. I hope that it helps you in understanding the concept of module A and module C. A and module C. We covered both modules in a concise manner. Everything is covered in this. Apart from this, tomorrow we are having the class for module B and D, where we will discuss all the concepts related to module B and D, and I will upload the PDF. And for practice of MCQ, we are having the classes from Tuesday, module A, B, C, D classes for the MCQs. So come and join at that time. And so that is it for today. Thank you so much for attending this session. If you like this session, kindly give the like and subscribe to the channel. Let's meet tomorrow. Till then, have a happy good day and thank you all.